rewrite the entire yield curve.
Lindsay, I'm digesting this idea of a wage spiral, and you're saying we're already seeing it, and it could potentially be out of the Fed's control. What data are you looking for to confirm this view that we are in the midst of a wage price spiral that has significant legs?
Well, I think the best evidence that we're going to see, the most conclusive evidence, is when the Fed begins to raise rates, potentially as early as the first quarter this year, or at least by the second quarter of this year. As the Fed begins that initial increase, if we continue to see price pressures rise, if we continue to hear from companies that they're being forced to elevate prices in order to offset labor increases, rent cost increases, that's really going to be the determinant that the Fed is not only behind the curve, but too far behind the curve that the traditional metrics of raising the federal funds rate will be able to control inflation.
Lindsay, how much is this view predicated on the idea that the participation rate will never recover to where it was before, and those people who have not gone back into the labor market post-pandemic are never going to return?
Well, I don't want to say they're never going to return, but I think it's a reflection of the fact that we're not going to see a return to the normal labor market in the near term. There was an expectation that as government benefits declined, as schools reopened, as vaccination rates increased, these workers would immediately flood back into the labor market. It's very clear that that's not going to happen. This is going to take a lot of time, particularly when we talk about consumers being able to accumulate such a sizable amount of savings that will now carry them for several months, if not longer, into the new year. So I don't think it's an idea of we're never going to get back to those participation rates, but it's going to be a very prolonged recovery before we see the labor market getting back to pre-pandemic levels of activity.
Lindsay, thank you. Lindsay Piegza there of Stifel on the U.S. economy, this Federal Reserve. Can we talk about China and Hong Kong just for a moment? More restrictions out of Hong Kong. More restrictions around flights into the airport, more restrictions around school closures as well. And Tom, here's the stat of the day. I'm going to read it twice so you hear what I said the first time, and you know I didn't just make this up. I'll say it twice. The city has tested around 920,000 people over the past 2 weeks. They found just 42 positive cases. That's 920,000 people they've tested, Tom, in the past 2 weeks, 42 positive cases. Doesn't that just capture the difference between the approach in China and Hong Kong right now, Tom, and the United States? That's Hong Kong, Tom, 920K over the past 2 weeks and 42 positive cases.
To take it down to the very basic, John, we're doing science based around statistics in the central limit theorem. They are not. They are doing social policy in a certitude that they can fix it. I noticed the Philippines today with restricted stock market hours. They've got some real challenges. And John, you know, there's every other story that's out there as well. But this is science. I mean, Amish Adalja is going to be with us, and he's heated about this.
It's just absent from the conversation right now, though, Tom, what is happening in China when we're talking about the Federal Reserve and the U.S. economy. I get it. Inflation's high. They're about to do something about it. But I just wonder what the trajectory of the global economy looks like when we know we've got a highly contagious variant circulating around the world, Lisa. We've got a vaccine in China that we know is not as good as the vaccines that have been used in the West, in the United States, in the UK, across Europe. And at the same time, they have a much lower tolerance level for infections. And throw in the fact that there are some Olympics taking place in the next month too.
This is a highly nuanced moment, and we're seeing this with retailers. Lululemon coming out yesterday with their earnings and going on the low end of their forecasts simply because of some of the disruptions due to Omicron and the supply chains from China. We're expecting to see that from other retailers. How much does China have to give in, especially if they have foreigners coming into their borders for the Olympics? How are they going to control this if it is so difficult and so transmissible, John, if they aren't going to give up the zero COVID policy?
Well, I sense not many foreigners are going into the country for the Winter Olympics.
I mean, well,
correct?
Yeah, look, even though they're the athletes, I mean, you can test, but somebody can develop an infection hours later. It just, they become more vulnerable, especially without the herd immunity at all.
It makes you question the hope that's out there around supply chain issues easing anytime soon as we look further out through
John,
22, Tom.
John, Anne-Marie just emailed in. I think she's scheduled to come up. The letter G is in the correct spot.
You're busy playing Wordle still?
Yeah, I am. The letter G is in the correct spot.
Have you managed to get a word correct yet? Have you managed to nail anything yet?
No, I haven't, I haven't done this.
You know what I love about this show sometimes? Lisa and I have a serious conversation. They actually made the banner. They They
know.
made the banner for you.
What can I say, John? The letter G is in the correct spot.
Okay. I'm letting this slide. From New York City this morning, good morning. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The US Senate is set to vote this week to impose tough new sanctions on the Nord Stream 2 pipeline. There is broad congressional opposition to the gas pipeline, which stretches from Russia to Germany. But some Democrats are concerned the sanctions would complicate ongoing talks between the US and Russia. Those discussions are aimed at easing tensions over Russia's troop buildup near Ukraine. Now, Federal Reserve Vice Chair Richard Clarida will step down on Friday, 2 weeks before his term expires. That is following new revelations about a stock trading on the eve of a major central bank announcement. Last fall, 2 regional Fed chiefs announced their departures after reports about their trading activity. In Hong Kong, authorities are doubling down on their controversial COVID-0 policy. They are reimposing some of the strictest limits since the pandemic began. Kindergartens and primary schools will close again. Meanwhile, passengers from what are considered high-risk countries are set to be banned from transitioning through Hong Kong's international airport. British consumers splurged on Christmas gifts last month. Retail sales in the UK rose 4.6% from a year ago. That's according to the British Retail Consortium. A separate report from Barclaycard says consumer spending was up more than 12% from 2 years ago, thanks to sales at supermarkets and fuel stations. And in college football, Georgia beat its bitter rival Alabama 33-18 for its first national title in 41 years. The Bulldogs came from behind in the fourth quarter to defeat the top-ranked Crimson Tide. Alabama had beaten Georgia 7 times in a row going into that game. Global news 24 hours a day on air and on Bloomberg Quick Take. This is Bloomberg.
Many people who are minorities don't any longer believe in the American dream. What do you say to these people about whether this country really still exists for the American dream?
The American dream is possible, but it is failing a lot of people because of some of these racial blinders that exist.
You mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates that say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the test strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is infected. We're going to be smarter, and we're going to pivot, and most importantly, we're going to defeat COVID.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Omicron has presented an unprecedented challenge.
It's mostly unvaccinated people that are hospitalized and that are dying right now of Omicron.
The protection that you are getting after an infection doesn't last as much as with the vaccine.
This is a drug that should and has shown that it works against the variants.
We have a really good vaccine, coupled with the fact that it's very tolerable.
I think the world should be in a better position with tests as we move forward.
Some of the top pharma CEOs speaking to Bloomberg just in the last 24 hours. From New York City with Tom Keene and Lisa Brambitz, I'm Jonathan Ferro. Your equity market up 17, up 0.4%, up 83 on the NASDAQ after yesterday's monster turnaround. Closing in positive territory yesterday after down by almost 3% at one point, up 0.5% again this morning. Yields 175.33 unchanged there. Crude advancing 1.5% to 79.40, and euro dollar just about positive, Tom. That currency pair up a tenth, 113.39.
2 cent spread, John, comes down this morning and just breaks through down to where it was January 3rd, first trading day of the year. We're at 83 basis points, 78, 79 basis points maybe would be back to 12/31, 2021. Right now, my interview of the day after what I've been through the last number of weeks, Amish Adalja joins us, senior scholar at Johns Hopkins University. Dr. Adalja, I've got 8 questions, but I don't want to be selfish here. Let me talk with the zeitgeist right now. What is the character, the nature of our hospitals in America? When you see the news stories about hospitalizations, translate that into the real world that you're living.
There's clearly been an uptick in hospitalizations, and that's not surprising based on the astronomical number of cases of Omicron that we have. These tend to be people who are not vaccinated, just like during prior surges. But what's different, even if you look at the raw numbers, and we see that we've kind of eclipsed the national number for last winter, is that it doesn't feel the same in hospitals. It doesn't feel as bad, and that's because there are at least, in some situations, 25 to 40% of people being admitted because of some other reason, and they're testing positive for Omicron because of the screening that's going on at hospitals. So that's why, at least in the hospitals that I've worked at, it doesn't feel anything like what it was last year. Although it is stressful, hospitals are crushed and have staffing issues, it's of a different caliber than it was a year ago. And I think that's a good thing. And it's a testament to the vaccines. And it's also a testament to Omicron being such a prolific variant that it's able to infect a lot of people, many of whom don't even know that they're sick with it.
You mentioned testing. Give us an update on your belief in the PCR test. The United Kingdom seems to have had their own calculus of how to deal with PCR. What do you want to see from CDC, from the White House, from Dr. Fauci to bring clarity and confidence in the longer-term PCR test?
Well, I think we have to have people take a step back and say, what are we trying to answer? What question are we answering when someone does a test? And there are 2 basic questions. The first is, am I a danger to others? Am I contagious? Is there enough virus in my nose and mouth to infect somebody else? And then the other question is, what am I sick with? The PCR is a great test when you're actually sick, but it's not going to give you a gauge on contagiousness because it's very, very sensitive, can pick up minute amounts of the virus, and that might not necessarily mean that you're contagious. It could be remnants from a prior infection. So we've got 2 different tests, antigen test, PCR test, and they each have their own lane. And I think you see all of this confusion in the media because people are conflating them and not taking a step back and asking the more philosophical question is, what question are you asking of the test?
Dr. Adalja, there's this angst among people who have not yet gotten the Omicron variant, that there's sort of an inevitability. Are cloth masks useless when it comes to preventing the spread at this point?
They're not useless, but they're increasingly becoming less and less useful, because when you have more contagious variants that can infect people who are fully vaccinated, the cloth mask is not going to be as efficient, because this variant is less forgiving. So the better quality mask you have, the more likely you are to avoid infection, at least for some period of time. So I do think it's important to upgrade masks, but it's also important to remember that these people that are trying to wear N95s and KN95s and not wearing them appropriately, sticking their nose out and they don't fit, that's not better than wearing a cloth mask. The best mask is one that you actually wear and one that fits your face. And for some people who are really trying to avoid infection, an N95, KN95, KF94, that might be appropriate for them. But for someone, for other people, including myself, I wear a regular hospital-grade surgical or procedure mask, and I'm okay with that.
Dr. Adalja, when you talk about philosophical questions, there's a bigger philosophical question as we talk about the approach in China, in Hong Kong, and the approach here in the United States. There is a feeling in the United States and in Europe that this is an endemic virus. We have moved into that phase. We are tracking it. However, we ultimately are trying to stave off the implications for our healthcare system. In China, they are clinging to the zero COVID policy. At what point does this become counterproductive and, frankly, an impossibility as this virus goes and gets around the world?
It's become a problem. It's become something that is impossible to do actually from day one. When you're talking about a respiratory virus that spreads efficiently, has an animal host, there is no COVID-0, there is no elimination, there is no eradication. The goal is to shift the spectrum of illness to the mild side. China and other countries like New Zealand and Australia have tried this COVID-0 policy with, I think, disastrous results, because it's not feasible and it actually stunts the ability of the population of the country to be able to learn to navigate a world in which COVID-19 is ever present, where they have to learn how to make risk calculations, where they have to get vaccinated to prevent them from getting severe disease. Because as soon as you start to have any type of social interaction, you're going to see the virus. It's not like this is a biblical flood and you can sit in Noah's Ark and wait for it to pass. It's going to still be there when you're done. And I think that's what many people fail to come to terms with. And I think it's going to be to the detriment of the Chinese people, because they don't actually know how to live in a world with COVID-19, because they're used to lockdowns and mass testing and all of the disruption, and think that's the normal. But that's not how you take care of COVID-19. What you need is a sustainable approach where you actually shift the curve to milder illness, and you use the tools of science and medicine to be able to teach the population how to reduce the harm from the virus, not to eradicate or eliminate something that is not eradicable or eliminable.
Doctor, I've got to squeeze this in because we're limited on time here, but how much protection does previous infection provide?
When it comes to severe disease, there is some evidence that for a period of months, maybe a year, you are protected from severe disease. It's unclear how much you're protected against mild disease. Clearly, Omicron can walk right through prior infection, just like it walks through the vaccine. So I think in general, what we want is hybrid immunity, people who've had prior infection to get their immunity topped off with the vaccine. That seems to be the best policy for people with prior infection, not to rely only on prior infection.
Doctor, wonderful as always. Dr. Hamish Adalja there of Johns Hopkins, and Lisa with some strong words for the Chinese Communist Party and their approach to dealing with this pandemic.
It's always been an impossibility, and in fact, it's detrimental because people are not learning to live with the virus. The key test will be the Olympics. How do they open up their borders to the world and try to have this global competition at a time when they are utterly shut with zero COVID policies?
The TK is going to be absolutely fascinating to see how this plays out in the next month or so.
I don't think they're going to open up the Olympics. I mean, didn't we see something like, John, maybe you mentioned this, where they're not going to allow clapping?
Yeah.
I don't know.
Cheering. Cheering.
Why do we think they're going to, quote unquote, open up the Olympics? I don't think they are.
Coming up, David Bianco, CIO of DWS Americas. He won't weigh in on this or weigh in on the market and the massive turnaround we saw on the NASDAQ just yesterday. The NASDAQ this morning up 0.6%. On the S&P 500 up 19, up 0.4%. From New York, on radio, on TV, for our audience worldwide. Lisa, Tom, and Jonathan, this is Bloomberg.
it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The aim for the Fed, it's not an unintended consequence, it's what they're looking to do, is tighten financial conditions.
I think they should go faster than what's priced into the market. I mean, they need to do at least 4 or 5 rate hikes this year.
Right now, they're too stimulative, and the economy, especially inflation, is too high.
There's going to be a lot of inflation pressure over the next few months.
We don't have a really good experience for the ability of markets to kind of calmly go through a tightening cycle.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Chairman Powell just a few hours away from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market up 14 on the S&P, up 1/3%. Tom Keene, even if the outcome is clear for Chairman Powell a little bit later, this could be a heated exchange down on Capitol Hill.
I'm watching 210 spread very carefully here, John, and it's sort of like the market. And granted, some of this is the sigh and relief off the huge equity move since, 2 p.m. Yesterday. But I'm watching the bond market, and I really wonder if it's front-running what Powell will say, where he will calm the inflation storms. I'm not predicting that. I'm just wondering how the market's gaming it into 10 a.m. this morning?
175 on 10s going into that. And Lisa, also going into CPI tomorrow, 7.1%. is the median estimate in our survey so far for headline inflation.
And right now, people are baking in 3 rate hikes, possibly 4 for 2022. Again, we've seen the buy the dip kind of mentality come in. How much is this predicated, John, on the idea that the Federal Reserve does not want to see markets sell off too much? And how much is that an anachronistic idea at a time where inflation is running at 7%?
Well, that's the point, isn't it? And to Bill Dudley's point yesterday, Tom, he's not just saying, let's go hard. That's the difference between Dudley and this Federal Reserve at the moment.
Well, there's a lot of differences here. There's what, John? It's like flavors of ice cream. There's 28 flavors here, from disinflation out to outright inflation. No question, Dr. Dudley is out saying this is a serious issue. They got to get out front, and just getting going isn't enough. He's looking at 4, 5, dare I say 7 rate increases down the road.
Tom, he's calling it Fantasyland forecast over at the Federal Reserve, and saying that Fed funds rate needs a 3 handle. Needs to push 4. It's just not part of the conversation at the Fed right now.
The Davids disagree. I don't know what David Bianco's going to say, but David Rosenberg does not agree with that assessment. David Blanchflower up at Dartmouth College, acclaimed, does not agree with that assessment. There's a lot of different opinions here, John.
Well, I don't think Danny thinks it should have a 1 handle either, Tom, at the best of times. Tom Keene, Lisa Bramett and Jonathan Ferro, your equity market up 16 on the S&P, advancing 1/3 of 1%. Yields unchanged at 175.51. The main event yesterday was the turnaround in the NASDAQ, down by almost 3%. Then back into positive territory. In positive territory again this morning, up 75. Lisa, up 0.5 of 1%.
Are bond markets and stock markets singing from the same hymnal? And this, to me, I mean, we were talking about that earlier this week. When do the pockets of pain turn into a more broad-based risk aversion? At 9 a.m. or about 9:12 a.m., Jonathan Ferro, I believe you know him, will be interviewing Cleveland Fed President Loretta Mester on Bloomberg Television. How much does she reiterate what we heard from Raphael Bostic of the Atlanta Fed earlier today, saying that he thinks that the March meeting could be the beginning of liftoff and that every meeting is live? Is the market really baking this in on the risk asset side or just on the edges in the debt markets? Today, Fed Chair Jay Powell center stage for the Senate confirmation hearings. How much does he reiterate inflation as the leading issue? How much does he say they want to see a market disruption in order to transmit their policy? He, in his prepared statement, he talked about using tools to support the economy and a strong labor market and to prevent a higher inflation from becoming entrenched. How much does this speak to that wage spiral, that wage price spiral that we just heard about from Lindsay Piegza? Then at 1 p.m., the U.S. Treasury Department will sell $52 billion of 3-year notes at a time when yields are at the highest level going back to February of 2020. How much does the international buyer come into play when we see this sell-off really broadening throughout the globe? And if not, if they do not come in a more meaningful way, John, do people rejigger their sense of how negative real yields can remain for the foreseeable future?
Important questions, Lisa, and thank you. Looking forward to the conversation, Tom, with the Cleveland Fed President, Mike McKee, joining me to help lead that conversation. Beyond just the March call, Tom, the interplay between the balance sheet and rate hikes is something you and I and Lisa have been talking about through much of the year so far. That's got to be a part of the conversation a little bit later this morning.
It's important with Mester, the mathematician. First of all, you got to ask her what she's going to do about the Cleveland Guardians. It's not her fault they changed the Indians' name to the Guardians, but she is math first, John, and I'm really interested in what she says about data dependency.
I sense she does not want me to ask her about the Cleveland Guardians, Tom. But I'll read in just
Guardians.
for you. David Bianco, CIO of DWS Americas. I think that's what most of the audience are thinking. Don't ask her about that. David, thank you for being with us. Let's start here.
Thank you. Good morning, everyone. Good
this cycle is moving so quickly, David. What do you make of that?
Right.
Just the speed of it.
The speed of the cycle is quick. It's a rapidly aging cycle. We'll see if it ages well or if it ages poorly. The cycle's 2 years old. This expansion's 2 years old. But I've used the expression it's going on 7. And as you know, 7, 8, 9, 10 is old age for an economic expansion. Last cycle was a record of nearly 11 years. But throughout this new expansion and this new bull market, it's been a very difficult market to knock down. We saw that again yesterday. We had a sell-off in the morning. By the end of the trading day, it seemed like nothing really happened. The two powerful drivers of this equity market have been earnings and low interest rates. And now the conversation is really about the sustainability of low and negative real interest rates. So all eyes are on the Federal Reserve right now, and are the views on how many times the Fed needs to hike this year and into next year. Well, that's a view that's in motion at DWS. My colleagues and I are talking about it all the time. But yes, there will be more hikes than previously thought in 2022. But the issue is not so much when the Fed hikes or how many hikes in 2022. The issue is really how high does the Fed need to go in 2023 or even 2024 to bring inflation back to 2%.
But David, the question is also what the intention of the Federal Reserve is in their rate hikes. Is it simply to slowly tighten the screws at a controlled pace, or is it to actually disrupt markets? How much is your constructive view that it's on the former and not the latter, that they're going to actively try to cause a sell-off?
Right. It's not so much about disrupting markets. or the equity market. Now, I don't think the Fed would be opposed to a 5 or even 10% dip in the S&P 500. And I think a 5% dip is very likely from the highs of about 4,800 on the S&P, but not a correction, not a swoon. I think what the Fed is up to is signaling that they don't like these entrenched inflation expectations. They're trying to, they themselves wrestle with what is a fair shift in the labor share of the economy from the profit share of the economy, given the tightness in the labor market, versus an accelerating wage price spiral. So that's one of the things I want to be listening to the Fed speakers all about. What's a fair increase in wages and shift in share of GDP versus, mitigating the risks of wage price spiral? And one other thing, maybe the most important thing, one of the most powerful transmission mechanisms of monetary policy is exchange rates. And if the Fed needs to hike the overnight rate above 2% in 2023, and our view at DWS, of course, there's risks around this, is that the Fed funds rate stays below 2% in the next couple of years. But if the overnight rate needs to go to 2% or higher, that will make the dollar stronger, and that will give the U.S. economy access to global resources, including the global labor market. And you will see the prices of many of these inputs, commodities and just goods be relieved in dollar terms. So there are many transmission mechanisms of monetary policy beyond giving some shock therapy to the equity market.
That's a complexity that's out there. David Bianco, you mentioned spiral, and that goes to the brilliance of one of your paragraphs where you talk about not the golden spiral, but the golden ratio. And what we're trying to do within a Chinese boom economy, folks, David and I are going to go all logarithmic here, but what we're trying to do, David, is get back to 1.6 to 1, which is a ratio of real GDP to inflation. What's your x-axis on getting back to the acclaimed goal? I sound like Kudlow. What's your ability, your timeline to get back to that perfect golden ratio?
Tom, I love that you asked that question and that you read that kind of detail in my reports. The golden ratio, 1.6, it's a golden ratio in many aspects of mathematics. It's beautiful, if you will. And a beautiful economy tends to be when real GDP growth materially exceeds inflation. And I think of a really perfect Goldilocks economy as roughly 3% real GDP growth with roughly 2% inflation growth. And so that's, almost 1.5, but a little bit better than that, you get to the 1.6 golden ratio. That is a good environment, not just for equity investors, but also for Main Street, where it's kind of shared prosperity and importantly, sustained prosperity. So it may be a number, this may sound wonky, but I'm going to take it back to the idea, if this is a cycle 2 years old, and we're concerned already about it possibly being overheated and it possibly being a short-lived cycle of 3, 4, 5 years rather than 10-ish years, it all depends on in 2023 and 2024, that denominator coming from 6 or 7% back down to 2 or 3%, preferably closer to 2, and that would get us to a cycle that's got greater prospects for longevity. Beautiful, golden, long-lived, 1.6, a good ratio of real GDP to inflation. I hope the Fed and other policymakers aim for that.
That's the challenge for them going forward. David, thank you. Thank you very much, sir. David Bianco of DWS. Tom, that's the big challenge for this Federal Reserve led by Chairman Powell.
Well, it's a shock then. I really want to go back to first principles here, and Powell won't get credit for this today from all assembled, John, but the idea here that we had a pandemic and we had an historic fiscal stimulus, which is the cause of all this. I don't believe it's meatpacker pricing, John. It may have to do with quadrillions of dollars pushed into the economy.
Would you like to have a conversation about the argument coming out of this White House, Tom? Is that where you're taking this?
Well, I'm going to let other people have the argument. Yes. I may ask
I think you're doing it right now. I'm blaming corporate greed.
I'm so much in the timeout chair this morning with other comments that
For good reason, TK, for good reason. Yeah. And if you missed it a little bit earlier, good. Tom Keene, Lisa Bramis and Jonathan Ferro. Futures up 14, up a third of 1% from New York. Heard on radio, seen on TV. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. US and Russian diplomats have agreed to keep talking. That was about the only thing resolved in a first round of security discussions in Geneva. There are big differences over Russia's troop buildup near Ukraine. Meanwhile, Moscow is concerned about the possibility that NATO may expand further east. North Korea's Kim Jong-un is ratcheting up tensions as he ignores calls for a return to stalled nuclear talks. For the second time in less than a week, North Korea has fired what appears to be a ballistic missile into waters off its eastern coast. South Korea's news agency says the missile flew at almost 10 times the speed of sound. Federal Reserve Chair Jerome Powell says the central bank will prevent higher inflation from being entrenched. Still, he warned that the post-pandemic economy might look different than the previous expansion. Powell's remarks are from an opening statement he will make at a Senate confirmation hearing later today. President Joe Biden nominated him for a second four-year term. In Chicago, public schools will reopen for students tomorrow. The teachers' union leadership agreed to accept a deal with city officials to restart classes in person. Schools have been closed since last week when teachers voted to shift to remote learning. They demanded that the city impose stricter protections against the coronavirus. And it's another win for organized labor at Starbucks. The union that won a landmark victory at a Starbucks restaurant last month also prevailed at a second New York store. That is according to a ruling from the National Labor Relations Board. Starbucks may indeed appeal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. This is Bloomberg.
There are a lot of EVs coming to market, and I'm wondering, do you think that just the market share explodes and there's room for everybody, or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market, and we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share will expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast, and we plan to have a few more $1 billion investment.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I would certainly be more restrictive. Even if there's nothing that's actually bad, it just looks bad, and it just raises questions that the Federal Reserve and other fiduciary organizations don't need.
Big conversation about the Federal Reserve and the trading activities of certain members of the FOMC. Alan Blinder there, the former vice chairman of the Fed. From New York with Tom Keene, Lisa Abramis and Jonathan Ferro, your equity market is positive, 15 or 16 points, up 1/3%. Nicely positive again on the NASDAQ, up 83. This was not the story at midday yesterday. Up 82, advancing 0.5%. Yields unchanged at 175.51. TK, what we really need right now is a drink. Just a drink.
Really?
Just a drink. That's what we really need right now.
Okay.
Just saying that's it.
Okay,
That's
thanks.
all.
Thanks,
all right,
John.
thank you.
All right.
TK, over to you.
Oh, thank you. We've got Tang over here. The Prosecco's out. We got to get more of that in, but we do have Tang this morning, John, to refresh as you choose. Right now, Anne-Marie Horton joins us in Washington, and we're going to stay on the important Powell hearing today. Anne-Marie, how does the left, how do the progressives address the chairman of the Federal Reserve?
Well, the very left, the likes of Elizabeth Warren, which already last year in September, she called him a dangerous man. She will continue on that same path, especially given the fresh news we have regarding Richard Clarida, who's stepping down earlier in light of those new trades about or transaction, which he pulled out from, then 3 days later decided to go in another direction, which even former Treasury Secretary Larry Summers says inconceivable. So you can imagine a lot of ethics are going to be, and these questions of ethics are going to be laid at the chairman today, as well as, of course, the topic of inflation. They want to know what the Fed is going to do to tamper inflation as he is going to be renominated, because we all know he's going to get through the Senate. That's already been decided. So a lot of this is going to be a little bit of a show, but there are a lot of questions right now stirring around the Capitol regarding ethics, and of course, inflation has been a hot button issue this year and last year as well.
So Catherine Rampel over in the Washington Post today does the inflation sum here of what the White House is getting wrong in their messaging. I get the senator from Massachusetts' messaging. I know she's speaking to the chosen few on the progressive left. What is the messaging of Chairman Powell today? Who's he speaking for?
I think he's going to be speaking for, he represents the entire Fed, right? And we're still waiting for what the Fed is exactly going to look like. We're still waiting on 3 nominations from the White House, which were promised before the end of 2021. Of course, that came and went. We still don't have them. But he's going to be speaking for the entire Fed, and the fact that they have went on this track of a dual mandate. They want to make sure that they have maximum employment. At the same time, at this moment, they have said time and time again last year that inflation was transitory, and it doesn't look like it's going to be that transitory. So he's going to have to come up with an answer on what they plan to do to really temper higher costs that everyday consumers are feeling, and that politicians have been asking questions about time and time again.
Yeah, and perhaps Jay Powell will give some indications on some of the key questions that markets are wondering. From a political standpoint, though, how much do you expect to learn with respect to the fiscal support, the fiscal stimulus that was on the table as of the end of last year and seems to be increasingly off the table with the BBB?
Well, with Build Back Better, Chairman Powell is going to avoid this like the plague. He's going to say this is not for the Fed to decide. This is something that legislatures and the Capitol needs to decide. This is something that politicians and lawmakers need to negotiate, and it doesn't have anything to do with what the Fed should be doing. Obviously, this is the time that the chairman did wade into a little bit of what was needed in terms of fiscal support was during the depths of the pandemic in 2020. But you're not going to hear him want to comment on many of these issues because that will just be a political crossfire for the individual.
Anne-Marie, a lot of these hearings, as you know, are not really to get information from the Fed chair. It's to send a certain message. And we're going to get a certain message, possibly from senators on both sides of the aisle, with respect to what they hope gets done or doesn't get done. How much is some sort of fiscal spending still being sort of in the front and center for why we're seeing inflation where it is right now?
That's certainly what you're going to hear from the Republicans, especially the likes of Senator Rick Scott from Florida. Time and time again, when you speak to him, he talks about the fact that he wants the Fed to really ratchet back also on their bond buying, and also the fact that the Democrats are just spending too much. And then you have the likes of Senator Joe Manchin, who says that one of his key items to even signing up for Build Back Better, about talking about it last summer, was that the Fed start ratcheting back on their bond buying, and also to get inflation under control. Now, we're going to get inflation data very soon, and we're expected to see potentially a 7 handle on U.S. inflation. We are seeing skyrocket inflation in other countries around the world. This is something that both parties are talking about.
Where are the other Fed picks, Anne-Marie? Where are they?
I don't have an answer for you. I wish I did. We ask every day when we're going to be hearing about the next Fed picks. It does seem like they have narrowed it down to a very select few for the vice chair of supervision and the other 2 governorships. But we just don't know yet. And it is frustrating because we were promised that we would get these Fed picks before the end of the year. And now we're in the 2nd week of January, 3rd week of January, and we still don't have them.
AMH. Down in D.C.
Yeah, it's amazing.
Thank you. And Tom, this is the essence of that Washington Post op-ed this morning. It's stop blaming corporate greed. You've got an opportunity here. Bring some credibility to the conversation. Say this is what we're doing with the Federal Reserve. Chairman Powell is volume 1 of that effort. Volume 2 is what you do elsewhere with the other empty seats. And Tom, the opportunity's there right in front of them, and they're dragging their feet, and I don't know why.
They got to get back to traditional messaging and be forceful about it. And I'll be honest, it takes a certain courage, and you'll see that from Vice Chairman Brainerd as well. John, I thought it was great. Anne-Marie got Wordle yesterday, surveillance Wordle. She nailed it. The word was Pharaoh. And Lisa with an early victory today. John, you and I just can't compete. You know, we mentioned the letter G, the letter M, and of course, Lisa nailed it. Today's word is gloom.
Is that it? Is that actually the word?
Yeah, that was today's
something
word.
else.
Lisa
I thought I let it slip early.
She got it early.
I didn't know that Wordle only did 1 word a day. I didn't know that.
I'm not going to get involved in this. I'm not going to spoil it for other people.
Do people take it that seriously?
Yes, of course. People have their moments of joy, their pockets of joy in a very difficult year. Let them have their Wordle.
This is a moment of joy, a pocket of joy. In a gloomy world.
When does Wordle go away?
I hope pretty soon, Tom. I hope pretty soon. Here's the market story for you. Up 15 on the S&P, on the NASDAQ up 82. Half of 1%. Those markets, Lisa. 176 on 10s. After the monster move we've seen year to date on 10-year treasuries, about 25 basis points higher. At one point yesterday, the move was about 30 basis points or so through 180. We've had a move on 2s as well. And that curve year to date so far, Tom, just a bit steeper.
Well, the curve's a bit steeper, but it's coming back here. I'm watching it very, very carefully into the morning, now just breaching 83 basis points. We don't need to microanalyze that other than to say, John, it's a market gaming out where we're going to be not so much after, but even during the Powell testimony.
The rate hike gain, Tom, is it fair to say consensus has shifted from, say, 2 to 3 to 4?
Are you
there yet?
I'm just not there. I don't want to get into the parlor sport of gaming the Fed hikes. I just don't want to go there.
Isn't that a game we play every single morning, Tom?
Every morning.
The street is addicted to it.
It's literally
Aren't we all hooked on it?
Yeah.
You're trying to get away from it, TK?
Tomorrow's Wordle word is dot plot.
Well said.
And that's a few extra letters, Tom.
Yeah, I know. I didn't do that.
All right.
Well.
No,
I failed.
just an extra one. Anyway, from New York, this is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lines from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
Actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood changing, the confidence boosting aspects, so the sort of tribal aspects of what fashion does.
Dan Tannenbaum, good friend of this program over the years, just called Wordle the Farm Villa 2022, Lisa. Does that make sense to you?
We're really still going with this, huh?
I think it makes sense to me.
Yeah.
I just, it's a pocket of, what did you call it? A pocket of what?
Joy.
A pocket of joy.
Joy in a bleak moment.
I'll give you a pocket of joy
Please
right
do.
now. Equity futures up a third
John,
on the
you
S&P.
are a pocket of joy.
For everybody out there, daily, Tom, you know that. Monday to Friday. Just 6 to 10 Eastern time. Outside of that, deadly. Nasdaq futures up 0.5%. Big turnaround in yesterday's session, down by almost 3% at one point, then turning back around into positive territory. Bit of a turnaround in the bond market, too, if you switch up the board. We breached 180 just briefly, then came back down to about 176. But on the year, still up 25 basis points. Talked a lot this morning about the move on 10s, the move on 2s, two-year yields to 92 basis points, up about 18 basis points on the year so far. And to tee up our next guest, Tom, we've got to talk about the relationship, or not much of one, between this and this. Switch up the board and let's talk about the US dollar. Last year, a move of almost 6.5%. Best yearly gain for the dollar index going all the way back to 2015. This morning, Tom, we're basically where we started the year, just short of 96, and that's where the conversation is for a lot of people in foreign exchange. Where's the relationship between higher rates, this conversation about rate hikes, and why is this dollar not moving much at all?
Yeah, it's interesting to see. And of course, the parsing here, folks, is a real rate analysis. Sometimes, yes, a nominal rate analysis will make some complexity, but also into what we see in flows. And John, this dollar dynamic here, we'll get to Mark here in a moment, is really important.
Looking forward to that conversation, Tom. Lisa, was that a pocket of joy for you?
I'm just absolutely overwhelmed.
Are you? It's too much, isn't it?
It's just overflowing.
The dollar 95.91. That's the cross asset price action. Let's get you some single names, some movers. Let's say good morning to Romain. Morning, Romain.
Hey, good morning, John. Anytime you have a big drawdown like we've seen of late here, you always have that line in the sand that people start to look for. Sort of what brings the dip buyers back in for the NASDAQ composite. It appeared to be right around 14,690, the 200-day moving average. We hit that early in the session yesterday. By lunchtime, we saw a pretty significant rebound. It's about 2.8% off the lows of the day for the NASDAQ to finish the day basically unchanged. Tesla was really emblematic of that, was down almost 5%, finished the day higher by 4, up another 1% here in the pre-market. Similar story for Alphabet, which was down 3, finished the day higher by 1, adding about 0.7% here in the pre-market. AMD higher by about 2% here in the pre-market, getting an upgrade actually over at Key Bank, some constructive commentary about some of the supply chain issues. Flip up the board here, you talk about some of the other movers out there. Intel actually showed a lot of strength yesterday and is showing more strength today, up 1.5%. A new CFO, actually getting the CFO from Micron, is going to jump ship over to Intel. A pretty big move here for CEO Pat Gelsinger, though some analysts are a little concerned about this. They're saying that while the new CFO is great, most of Intel's problems aren't really financial. They're much more about operation and execution. Illumina, the gene sequencing giant, they actually came out with some preliminary numbers, guiding a little bit higher here, both in terms of revenue and EPS. Their shares up about 4% here in the pre-market. And Rivian setting up for what could be, Tom, a 7th straight day of losses here, down about 3.6% here in the pre-market. Of course, a lot of that started, Tom, on those concerns about Amazon. We learned last night that their COO, left the company last month.
Romaine, thank you so much. Romaine Bostick on the equity markets. Look to the close this afternoon after the Powell hearings. To be some, if it's like yesterday, it's going to be important to watch what happens in the afternoon in the equity markets. Right now on the dollar is litmus paper for the global system. Mark McCormick joins us, and I'm going to go all Michael Rosenberg on you, Mark, in his classic textbook on currency, which is, there's the rate analysis, but there's also the flow analysis. You say we need to pay particular attention to the current account balances in 2022. How will flows adapt and change the U.S. dollar?
Yeah, that's a great perspective, because I think if you look at the current account dynamics between the U.S. and China, we're back to a world that's imbalanced. The current account surplus in China is rising. Current account deficit in the U.S. is also rising. So there's an element here that the impact of COVID has kind of changed the entire macro dynamics, which is the service sector.
Hello traders, how are you doing today? What a place to sell short euro. So if you're looking to trade euro against United States dollar, the price I'm looking to sell 113.38. Just right here. Okay, I'm order placed. So please place your order and wait until it gets filled. For those guys who don't have a strategy, please get it from company.co.uk. And for the rest of you, you have the strategy, you know what to do. Please follow the guidelines and let's make this trade profitable. Stay safe. I'll speak to you later.
What does he have to say about your world of trade flows to politicians worried about inflation?
I think he has to, outside of the trade flows, is kind of go back to what I'm saying, is there's an element here that the supply chains have been disrupted. Countries are on different operating systems around how they're dealing with COVID. And that is part of this cyclical driver of inflation. So we won't talk about transitory anymore. That word is gone. It's not in Wordle, as you had mentioned. But cyclical dynamics around inflation are still tied to the supply chain. And so when everyone starts to move back into a synchronized COVID cycle, and we see this in our daily mobility tracking, we're not seeing the same level of dispersion across country mobility that we saw during Delta. And we've also seen Omicron start to peak in terms of dispersion. So there's an element here, we are moving back towards normal. And the reopening and the rebalancing of those channels would help for inflation to come lower. And you're also seeing it through a lot of the high frequency data on shipping and tracking and freights. And those are all big drivers of inflation, along with the base effects that come through on the energy spike that we saw last year.
Wait, are you still in camp transitory, even as we get more histrionics about the idea of a wage price spiral and runaway inflation?
Well, I think I think an important way to talk about it is cyclical and structural. And there are structural drivers of inflation that are changing, and they were changing through the 2018 trade war. The whole theme around Brexit and the trade war and all the things we've gone through for the last decade is related to deglobalization. So there's an element here that international relations has been a big driver, and international political economy is a driver of globalization, which has been basically in tow for the last decade. So deglobalization is, a structural driver of inflation. Lower productivity and less labor market participation is also a driver of structural inflation. But the supply chain is partly a cyclical driver, and there's elements here that when this corrects, we will see inflation along with the base effects start to come down in the second half of the year.
Mark, I'd love you to respond to David Bianco of DWS earlier, who talked about the transmission mechanisms of Fed policy and how if they were to raise rates faster than expected, they could give strength to the dollar, which is a transmission mechanism in itself because it would bring down the cost of things on a trans-border perspective. Do you think that this is actually a way that the Fed can transmit, or has the FX channel gotten too muddied?
Well, they're all part of the same mechanism. So if you accept tighter financial conditions and a stronger dollar, you are going to pull inflation lower. I just don't think that the trade channel works as well as it used to. If you think about globalization itself and the intermediary components that happen across all these different borders, even if you think about the complexity of NAFTA between U.S., Mexico, and Canada, there are so many different intermediary components that go into all the different supply chains, even in NAFTA, that the currency strength through trade flows doesn't really have the same impact. But there is an element that a stronger currency will tighten financial conditions. Tighter financial conditions kicks back into monetary policy. And I would argue, and I think probably most policymakers argue, that they're focusing on the financial conditions. So the broad-based tightening of financial conditions will help pull inflation lower over time with a bit of a lag.
Mark, just quickly, a final question from me, and it's more about sort of sentiment. You're in Canada right now. Your experience at the moment, when you speak to people based in the United States, based in Asia, is there a home bias just in terms of what shapes their view of the world? Is it dictated by where they live and the conditions and the restrictions around COVID?
Yeah, I guess there's a word maybe around jealousy in terms of, weather, demographics, and kind of how people are looking at other countries and restrictions. So I'd say there's an element here that what we're doing is we're tracking the mobility data, the lockdown data. We're back into the high frequency data around that. So I think there's an element that markets are kind of representing, part of the openness, because the openness and the mobility is also being reflected in the growth numbers. And what we've seen in Canada is that mobility has declined. What we've seen in Germany is mobility has declined. And those things are, basically correlating with the movement in the lockdown indicators that you get from the Oxford Stringency Index. So there's an element here that investors have to be focused on what's happening on the ground, particularly in mobility, because if people are no longer moving around, it's a sign that growth is going to slow, at least in the next quarter, the second quarter after that. So there's an element that currencies, we wrote a paper on it in December where we back tested a strategy where we looked at growth expectations, augmented and adjusted with mobility indicators. And essentially what we got was a very high Sharpe ratio relative to a baseline of just trading currencies on growth. So I do think there's an element, yes, that this is top of mind, maybe because people are just kind of seeing what everyone else is doing around the world, but it also matters a lot for investment flows on the currency side.
Fascinating stuff. Stay well, Mark. It's good to see you. Mark McCormick there of TD Securities. And Lisa, there are some massive differences right now between, say, Canada, parts of the United States, Europe, and, say, Hong Kong and China right now.
I find that so fascinating. I want to sit on that for a second. Mark McCormick's point that if you take a look at the mobility data, it directly correlates to growth and, frankly, can be really illuminating for an FX trading strategy in the near term, even if it is only a quarter. To me, is fascinating at a time when so many people have really moved beyond the pandemic, at least in their thinking.
Well, think about a government that's trying to move beyond the pandemic, Tom. The UK, the British government.
Well, I'm going to give him a high mark.
Boris Johnson, cable 135.83.
Yeah, I'm uninformed on this, but frankly, I'm going to give him high marks on this. What I would say about mobility, John, and this goes off the great work of John Sylvia, of course, for years associated with Wells Fargo. And Dr. Sylvia made very clear mobility is at the heart of the American experience, and that pushes against what we heard from Ray Dalio today.
I miss John. He always wanted me to teach you about cricket, Tom.
Yeah, well...
I never tried. I'll leave that for someone else. Coming up,
John
David
Riding
Harrow,
has tried and,
Chief Investment Officer for International Equities at Harris Associates. That conversation is just around the corner. No doubt a conversation on European banks with him too. Futures up 15, advancing 1/3% on the S&P. We're up 76 on the NASDAQ, up 0.5% from a beautiful New York. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The U.S. Senate is set to vote this week to impose tough new sanctions on the Nord Stream 2 pipeline. There is a broad congressional opposition to the gas pipeline, which stretches from Russia to Germany. But some Democrats are concerned the sanctions would complicate ongoing talks between the U.S. and Russia. Those discussions are aimed at easing tensions over Russia's troop buildup around Ukraine. In Hong Kong, authorities are doubling down on their controversial COVID-0 policy. They are reimposing some of the strictest limits since the pandemic began. Kindergartens and primary schools will close yet again. Meanwhile, passengers from what are considered high-risk countries are said to be banned from transitioning through Hong Kong's international airport. Right here in the UK, opposition politicians are calling on Boris Johnson to resign. It has to do with an alleged drinks party held in the Prime Minister's Downing Street office garden while pandemic restrictions were in place. It is the latest in a string of of allegations about rule-breaking parties. They are being investigated by a senior civil servant. JP Morgan CEO Jamie Dimon has issued a warning to the bank's unvaccinated workers in New York. On CNBC, he said that if they don't get vaccinated, they won't be allowed in the office. And if they are not at the office, Dimon says they won't get paid. He says 97% of JP Morgan employees in New York have had their shots. And in college football, Georgia beat its bitter rival Alabama 33-18 for its first national title in 41 years. The Bulldogs came from behind in the fourth quarter to defeat the top-ranked Crimson Tide. Alabama had beaten Georgia 7 times in a row before that game. Global news 24 hours a day, on air and on Bloomberg Quick Take. This is Bloomberg.
Many people who are minorities don't any longer believe in the American dream. What do you say to these people about whether this country really still exists for the American dream?
The American dream is possible, but it is failing a lot of people because of some of these racial blinders that exist.
When you think about schools in particular and children, where we've seen pediatric hospitalizations actually on the rise amid the spread of this variant, do you think keeping schools open is the right move?
If done well, school is a relatively safe environment for kids. Masking, tests, especially during the surge of cases, I think it is very important for kids to be in school, and I think the chance that school becomes an explosive source of new infections is low with precautions.
10 million cases in just a week. Are we reaching a peak of this wave, considering how quickly it is spreading through the population?
I think at a certain point it really has to slow down, and that's probably within a couple weeks or a few weeks away. And that's, I think, going to be good news. The question is, can we keep hospitalizations down enough during this period so we're not swamping hospitals?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
it'll be quite some time before markets start digesting a slowdown in growth, which is what's penciled in as a risk for 2023. If you see that hot economy start to be questioned, that's when markets are really going to have a problem, and you're going to run the risk of really seeing a substantial decline. But we're not there yet.
Laurie Cavacina there of RBC Capital Markets, talking up the possibility of a story of two halves this year. The front half about as cyclical as the back half about maybe big tech. From New York this morning, good morning, Tom Keene, Lisa Bramett and Jonathan Ferro. Your equity market is positive. It's up 0.25% on the S&P. On the NASDAQ, it's up 0.4%. Yields are unchanged on 10s at 175.86. It's worth pointing out, Tom, that's not the case on 2s. At the front end of the curve, 2-year yields are up again by 3 basis points to 0.927%. So as you've indicated, Tom, that's a flatter curve.
Well, let's dive right into this right now. It's a flatter curve ever so slightly, not back to where we were 1230, 1231, but we're getting there off of the angst of the last number of days. Part of this is the parlor game of Fed guessing. We go with a chart and then we go with wisdom. First, Kriti Gupta has a wonderful chart for us. Where are we out to? Are we out to 7 rate hikes yet, Kriti?
In some parts of the market, we're out to as much as 8. But I mean, this is really the heart of the issue here, that so many different players are pricing in different things. The dot plot still shows 3 rate hikes in 2022. Goldman, JP Morgan looking at 4. Look at Jamie Dimon, he's saying at least 5 just this year. So that really brings me to my chart of the day here to look at what markets are actually thinking. This is the spread of euro dollars over the next 12 months, essentially 3-month contracts used to kind of see what the next interest rate expectations are, also used for hedging against those expectations. And really for our radio audience, what you need to know is that the line just gets steeper and steeper, at least in the past 6 months, now hitting 100 basis points over the next 12 months, essentially pricing in that 4th rate hike for 2022. This is significant because not only are you seeing in 10-year yields, for example, a 47 basis point rise over the last month or so. So you're actually already seeing some of that priced into the market, but you're also seeing that 4th rate hike being extra significant because some folks have said, traders especially, have said that perhaps that 4th rate hike getting priced into the underlying bond market, perhaps that could be the straw that breaks the camel's back, at least in terms of the equity market. I'm not just talking about tech and those long duration assets, but perhaps even, dare I say it, an actual technical correction in 2022.
Thank you so much. The clarity there of the chart. On radio, that chart looked especially good. Always looking good on radio. Michael McKee steps in now. We can go like 14 topics here, but let's focus on the parlor game of the moment. Have you ever seen it this silly?
Yeah. I mean, this is what happens. The Fed makes a prediction, and their prediction sits still for 3 months until they get their second chance, another chance at making one. And the markets adjust every day. With apologies to your radio audience, I don't know if they can bring this up here, but the odds of the Fed rate cut, there it is, the odds of the Fed rate cut. And what you see is it's moved up, but moved in. We're pricing in a sooner rate move, and that's perhaps more important to the markets right now than where they end up. And the reason is if they can go to the next chart, and this is the last one I'll show on radio, is the dot plot.
Yeah,
the dot plot has not changed. For because of course the Fed hasn't moved anything, but look at the blue line. That's the option adjusted spread that Kriti was just talking about. They don't think the Fed gets to a terminal rate. They don't think the Fed gets to 2.5%. So yeah, we're talking about earlier rate hikes, but we're not talking about significant rate hikes.
Al's out on I-80, just drove off the road here with all the charts that we're doing here. The summary of this, Mike, for radio and for television is we're making it up as we go. How does Chairman Powell articulate that today without showing dot plot charts that the left and the right don't care about?
Well, he's probably going to emphasize the statement he made in his prepared remarks, the idea that the Fed, the economy is going to be different and the Fed has to adapt to a changing economy, which is what they always do. Nobody really knows what's going to happen. And the thing that these dot plots and projections for Fed rate increases leave out is the reduction in the balance sheet. What's that worth? How many basis points is that worth? Does that take the place of one or more of these cuts? The Fed has some strategy decisions to make.
There's also an issue with what the Fed put is worth at this point. And we keep having this discussion as people come in and buy the dip that we saw yesterday. How much are we expecting the Fed to give some indication of what market disruptions they are and are not comfortable with?
Well, you would have to ask him directly, Jay Powell, directly, to get an answer to that question, because he's not going to bring up the markets on his own. The Fed doesn't care if the market goes down. The Fed doesn't care if there's a technical correction or not. What they care about is whether the system is functioning and whether the market goes down too quickly and starts to seize up. That's what happened in March of 2020 and why they stepped in. But as many a Fed chairman has said over the years, stocks go up and stocks go down. They can't be too influenced by that.
Looking forward to you leading the conversation a little bit later, Mike, with the Cleveland Fed President, Loretta Mester, Mike McKee there. We'll be on Bloomberg TV and Bloomberg Radio at around 9:15 Eastern Time as we both catch up with the Cleveland Fed President. A couple of stories I want to pick up on. Here's the first. It's from Dow Jones on Citadel. Citadel Securities is set to receive its first outside investment in a deal valuing the electronic trading firm majority owned by hedge fund billionaire Ken Griffin at around $22 billion. That's the lead paragraph from Dow Jones right now, Tom. They go on to say venture capital firm Sequoia Capital and cryptocurrency investor Paradigm have agreed to invest $1.15 billion in the Chicago-based firm.
I can't emphasize enough, John, the importance of these two names. Paradigm may be less known, but Sequoia Capital, when I saw that come up, this is, I'm sure, what Citadel, not only the hedge fund, but separate from that, the order flow firm, this is exactly what they wanted. This is the good housekeeping seal of approval from venture capital.
Your headline there, Citadel Securities to receive first outside investment. The second story I wanted to talk about, Tom, I'm sure it got your attention too. Goldman's call for China GDP has just come in, a revised forecast to 4.3%. They revised their forecast lower, 4.3%. Now, initially, Tom, my reaction was just to compare and contrast with America. The Fed has got real GDP growth in this country, in America, this year at 4%. So that's Chinese GDP coming down to where U.S. GDP is set to be in 22.
The history of this, John, is 6% has been the benchmark for labor stability within China. That's just been a guidepost along the way. And this alludes to what we've heard from Elizabeth Economy, among others, and also at the China Beige Book, is, well, that anything under 6%, you begin to get into domestic tensions that, frankly, we don't focus on all that much.
Lisa, Goldman's new call, 4.3%. That's your GDP forecast for China in 22.
It's for China, but how much does this dovetail into the global projection, especially as we had heard from Francisco Blanche yesterday of Bank of America saying that this is the biggest risk, downside risk to their call of oil prices above $100 a barrel by the second quarter. How much does this influence how much inflation and how much growth, especially with the supply chain disruptions? I mean, to me, the big wild card as they pursue the zero COVID policies.
And Lisa, if this is because of COVID, what does it mean for supply chains? What does it mean for the inflation story as it flows back into America? And is it more likely the Fed has to do more or do less? That's where it gets a little bit complex.
Especially as you start to see companies increasingly raise their prices because of the kinks in the supply chain that seem to be persisting for longer.
And in turn, wages go up.
There you go.
As well. And that's the story we've got to live with right now. Up 13 on the S&P, up a third of 1% from New York City. Great week coming up. Chairman Powell testimony, a reconfirmation hearing a little bit later. CPI tomorrow, retail sales on Friday, on radio, on TV. This is Bloomberg Surveillance.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dinings, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Investors are hard-pressed to find a better place to invest for the future than the United States.
Take advantage of some of the volatility there, the volatility in terms of the rates increase, the volatility that we're seeing in terms of anticipation of earnings.
Do not chase that last year's performance.
The bond market seems to be pricing in a very hawkish Fed.
This is a repricing. It's painful. It's got a little bit more ways to go.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An eventful day here. Of course, Chairman Powell, testimony later. Thrilled you're with us on radio and television. And John, you know my theme has been corporations will adapt, and it's just a symbol for Jerome Powell. But the Citadel transaction today is another example of corporations adapting, John, to all the cards they've been given.
And Tom, that was your big call in 21, and it was dead on. Margins held up big time. It was a big surprise for a lot of people, an upside surprise for this equity market. Coming into 22, Tom, this market's got to adapt to a Federal Reserve that wants to go, wants to take rates higher, and in Bill Dudley's words, maybe, perhaps, much higher.
The Fed will be fascinating today, and of course, before that, Loretta Mester with Michael McKee and John Farrow, that will be riveting as well. But John, I want to dovetail all these pieces in. James Dimon moved the market yesterday, the huge reversal that we saw. How does Mr. Dimon and his team react to what we see from Citadel? I'm sorry, this is real-time 2022, and that's where you get to the growth message that we heard from Mr. Dimon yesterday.
Let's get back to work as a theme on Wall Street, point one.
Yes.
To Jamie Dimon's point yesterday on CNBC yesterday, Tom, which is the interview that you're referring to. The major point there is the economy is not the market. The economy and consumer balance sheets, fantastic. The market is a very, very different conversation, and we need to distinguish between the two in the hours and weeks and months ahead.
Lisa, how are we going to distinguish it this morning at 10 a.m.? I mean, it's going to be fascinating to see how he threads the needle around the politics of left and right.
How do we determine how much weakness we can see in the market to allow the economy to continue to grind in a controllable way without some sort of wage price spiral, as Lindsay Piegza was talking about, without some sort of disruptive bout of inflation that could crimp growth going forward, Tom?
I'm going to say, John, we got to get to the data check here before we get to Brennan. To me, it's incredibly nuanced right now in that there's not a lot of movement, but it's really actually quite interesting.
We had a ton of movement yesterday. The Nasdaq down by 2-3 percentage points and a big turnaround. Nasdaq futures positive again. We add some weight to that turnaround, up 45, advancing 1/3 on the S&P, up 9, up 0.2%. The move in the bond market's interesting. The 10-year always gets the headline attention. 175.86 briefly through 180. Twos are higher again, Tom, by 3 basis points to 92. It's that front end of the curve conversation I'm more intrigued by. Higher interest rates, yes. More hikes, yes. As Mike McKee pointed out, when we catch up with the Cleveland Fed President Loretta Mester a little bit later, I want to understand the relationship between the balance sheet and rate hikes. Do they complement each other? Does one replace the other? That's what I want to work out when we hear from these Fed officials, Tom, in the next few weeks.
Part of the data, John, is we've got to talk about inflation in Washington, and that's a gallon of gas. Brent crude, $82 a barrel. I'm going to call it $2, $3, $4 from new highs.
Blame corporate greed, Tom, apparently. Blame corporate greed. And you've picked up on this story. It's not resonating.
No.
With the election base, with the electoral base, Tom, and that is a massive, massive problem for this administration.
Greg Valliere,
it's not about corporate greed.
Yeah, Greg Valliere, the scathing note, AGF, just saying the Democrats are off the mark there, and particularly the president is off the mark. This is going to be really eventful, folks. Not another Fed testimony, but something really interesting on the renomination of a chairman of the Federal Reserve. Lisa, very quickly to you, there's an auction today. Do I care?
Yeah, you care because it's 3-year bonds, and this is really the key determinant. Yes, it's fascinating to me. All of the auctions going forward are going to be pretty interesting, because we do have the Federal Reserve that's going to be buying fewer bonds later on. Not yet. They're still expanding their balance sheet, as John will point out. But not only that, but you're having 3-4 rate hikes getting baked into the assumption for the United States this year. How about 2023? This is sort of the issue of, do they go faster at the beginning and then they stop, or do they continue with aggressive rate hikes, as the likes of Bill Dudley perhaps would like to see?
I don't have a clue. I'll wait for inflation tomorrow. Right now, Brent Schutte gets us started here. We got a really eventful hour for you on radio and television with Northwestern Mutual, where short term is 5 years. Brent, forget about short term is 5 years. Let's bring it in big time to a 3-year perspective. What is the 3-year perspective given the cacophony right now?
I think in the near term, I actually think the market has legs to go higher. Now, I know we're going through this painful kind of rotation, which has always been a question of ours. Can you actually deflate some of the more excessive parts of the markets without causing that to leak into the broader market? And so far, despite all that commentary, you have seen value stocks hold up well. You've seen hopes, dreams, themes, and memes, some of those things that didn't make sense, that were bid up on excessive monetary policy, they've deflated more than 50%. I think you continue to see that throughout the year. I think hopefully we get better news on COVID. I think inflation does pull back as we shift more from goods buying to services buying. And then I think that allows the Fed to be just a bit less aggressive than market is pricing against an economic backdrop that is still strong. And I think the first half is a pretty good part of the year.
So monetary policy right now, Brent, and just to jump in because this is important, you think this is a problem for pockets of the market, not the overall market, at least in the front half?
Yeah, and that was mentioned by Tom in the opening when he talked about a nuanced market. I mean, you're seeing parts of the market that are actually doing okay the last few weeks. You've seen value stocks hold up quite well. Look, you've had an abnormal economy. The word economic adaptation has occurred. We had that forecast for a while. That has led to market abnormalities. Hopes, dreams, themes, and memes are one, but then you also have growth stocks trading at record PEs relative to value stocks. You have large caps trading at record PEs relative to small caps. And so we think that as the economy normalizes, which we think we're continuing to do, the market will have to normalize. And that means that part of the market that hasn't done as well, that is quite frankly cheap, will do better as real interest rates move higher.
Take me to the second half then.
I worry more then because at the second half of the year, we could be out of economic slack or moving towards that. Think about it this way. At the end of 2019, we had a pretty tight labor market. Between now and the end of the year, we could be back to where we were in 2019 at the end of that time period, a later economic cycle market where we're out of labor market slack. And then the question becomes, can productivity keep up? We only have around 4 million more people to hire before we're back, all else being equal, to where we were in 2019. And at 200 to 400,000 per month, that means 10 to 20 months before the labor market could potentially be tight. And that's when you might have more real inflation, not the one that you're having right now, which is based upon COVID and some of those abnormalities.
Brent, you talk about the first half and the second half and a bifurcated nature between the two halves, and you're not alone. A lot of people have said the same thing. How do you arrange a strategy where you have the flexibility to rejigger at a time when everybody is doing the same thing in response to the same inputs and liquidity is being drained from the system?
Yeah, I mean, we've been overweight more of the value of the small, the cheaper parts of the market for some time, and we're going to continue to be overweight those parts of the market probably to the middle half of the year. And then we start looking and thinking about, do we want to bring our equity ratio down just a bit to reflect the fact that a lot of the easy money has been made, the labor market may be tight then, and the output gap, which is an important concept, may be closed. I still think the economy has legs into 2023 because I do think productivity is kind of the unsung story that will become kind of the more sung story towards the second half of the year. And that keeps us going in 2023, 2024. But certainly the risks are rising.
Brent, you said that you would reduce equity exposure and then go into what? Are bonds the place to go? Do you go into Bitcoin?
No, not Bitcoin. I said hopes, dreams, themes, and memes, and I would extend that to crypto just as a kind of a framework. You know, that's a good question, and I guess we'll cross that bridge when we get there. I think you're going to see yields normalize a bit more in the coming months, which could provide more of an opportunity in the bond market for a real return at some point. But for right now, we are still overweight equities relative to fixed income, and we'll play that day by day.
Brent, final question. Can I call -9 Celsius cold? Is that cold enough for you?
It's cold enough for me, and it's cold enough here in Milwaukee, although I'm sitting in my basement, so it's rather warm down here, but I think the temperature is around 0 outside.
0 Fahrenheit.
0 Fahrenheit. That's all I do math in, Fahrenheit.
Brent, thank
John,
you, sir.
we don't do Celsius.
Brent Schutte of Northwestern Mutual. I'm just not familiar with Fahrenheit, Tom. I asked Brent, Tom, because every time I say it's freezing, you tell me this is nothing. It is freezing in New York.
Today we're on, we're not on the edge of Buffalo today or
it's
International
-9,
Falls,
Tom.
but it's...
Come on, that's the real deal. This weekend in New York,
January.
Tom. This weekend in New York, -12 Celsius.
That's
just for the rest of the world. Do you want to convert that to Fahrenheit?
This is watchable. I'll tell you, Celsius and Fahrenheit. Fortunately, neither word can be a Wordle word.
Fargo, North Dakota, -5 on Friday. So just to put it into perspective.
Lisa, how long, Lisa, in Fargo, did you have a car running before you got into it? What was the record length? An hour?
I had a used car that was pretty cheap that ended up actually dying for a month because it was so cold and I didn't plug it in at night. But I digress. Let's move on.
I was going to ask something rude, like why do people live there when it's so cold? But I don't want to offend anyone
Look
this
at those
morning.
markets.
Look at them.
John, you're
Futures
killing it this morning.
11 on S&P as I insult a ton of the country. Up 0.25% on the S&P. Lisa was telling me the brain drain problem is a real thing, that young people were leaving.
Yeah, absolutely. That's been a big issue. And you've actually seen a real aging in the population, which becomes a problem for things. And we could link it back to COVID, because then what you have is you don't have the workers to actually help with the nursing and the other types of medical help when people get sick, and people are more prone to getting sick. So this has been a huge issue in a lot of the Midwest.
This is what we do. That was the intention, from the temperature to demographics. America and the pandemic. Main event a little bit later. Chairman Powell, 10 a.m. Eastern time.
That one.
His reconfirmation hearings a little bit later. That was a pocket of joy, wasn't it? Reconfirmation hearings a little bit later in front of the Senate, Tom. Clearly, the outcome for many people is done, dusted. A lot of people feel that way. I think this could get quite heated, TK, ahead of this inflation print tomorrow. North of 7 is the median estimate.
I will state this is not a normal testimony, not a normal renomination. Maybe it gets heated, maybe it doesn't. I do take your point, John. Everybody's making film for their campaigns of November 22.
This is not a normal show either. Tom Keene, Lisa Bramwitz, Jonathan Ferro.
God, I've never wanted a commercial break so much.
Put that in a promo. Up 0.2%. When the audience feels the same way, they've got a problem, right? Up 0.2 on the S&P from a cold and beautiful New York.
Maybe we'll be back.
This is Bloomberg.
With
With the First Word News, I'm Leanne Gerrans. US and Russian diplomats have agreed to keep talking. That was about the only thing resolved in a first round of security discussions in Geneva. There are big differences over Russia's troop buildup near Ukraine. Meanwhile, Moscow is concerned about the possibility that NATO may expand further east. North Korea's Kim Jong-un is ratcheting up tensions as he ignores calls for a return to stalled nuclear talks. For the second time in less than a week, North Korea has fired what appears to be a ballistic missile into waters off its eastern coast. South Korea's news agency says the missile flew at almost 10 times the speed of sound. Federal Reserve Chair Jerome Powell says a central bank will prevent higher inflation from being entrenched. Still, he warned that the post-pandemic economy might look different than previous expansion. Powell's remarks are from an opening statement he'll make at a Senate confirmation hearing today. President Joe Biden nominated him for a second four-year term. In Chicago, public schools will reopen for students tomorrow. The teachers' union leadership agreed to accept a deal with city officials to restart classes in person. Schools have been closed since last week when teachers voted to shift to remote learning. They demanded that the city impose stricter protections against the coronavirus. And it's another win for organized labor at Starbucks. The union that won a landmark victory at a Starbucks restaurant last month also prevailed at a second New York store. That is according to a ruling from the National Labor Relations Board. Starbucks may indeed appeal. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be how quickly can we, all of us, execute to build capacity to meet that demand. And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood changing, the confidence boosting aspects, so the sort of tribal aspects of what fashion does.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We still think triple-digit oil is within the works heading into the second quarter. We see demand recovering quite meaningfully. OPEC Plus supply is likely going to start leveling off in the next 2 months. A strict lockdown in China, broad-based, will lead to meaningful demand loss.
Francisco Blanch there of Bank of America on global commodities on China. Goldman this morning revising their call for Chinese growth this year from 4.8% on GDP in 22 down to 4.3. From New York, alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equities doing okay, up 10 or 11 on the S&P, up 0.25%, up 56, call it 57 on the Nasdaq, up 0.4%. Yields unchanged on 10s, coming in about half a basis point to 175.51, up about 2 or 3 on the front end, back through 90 basis points on a 2-year. It's been a while, and a ton of people, Tom, writing in. A couple of questions. First one, what the hell was Bramo doing in Fargo? We'll save that story for another day. Second one, Tom, a listener in New Jersey, it is brisk, not cold in New York today. It's not enough for them.
It's a horse farm. You know, you go out in New Jersey, there's like different New Jerseys, John, and there's like a New Jersey farther out where like everybody owns 400 acres and 40 horses. That's Al. Al from New Jersey.
This guy
emails in from a horse farm. He says
he's from the cold part.
He's brisk.
Do you know for a fact he has a horse farm? Or
He's out in the lower 40,
he's making that up.
where
Are you
the horses in the spring go. You know, it's brisk. You know.
And he's commuted into New York, and he's decided that it's not cold. It's brisk.
I don't know, he's
on a horse.
He's a walking Orvis commercial. You know, he's got the boots and the whole thing.
I just can't relate to Fahrenheit. In fact, someone wrote in on Twitter, and this is just perfect for me because I totally agree with them. This was from Trading Floor Audio. It is strange in the UK we tend to talk about cold weather in Celsius and warm weather in Fahrenheit. Fahrenheit, I get. You say it's 80 plus. I know what I need to wear. Once we get past September, Tom, I am utterly clueless on Fahrenheit. You say we're in the 50s. I don't know what that means. Is that a jacket? A sweater?
Brisk.
I don't know. It's brisk.
It's brisk. I grew up looking out the window in the kitchen. In many days, it was a -3 or a -2. Not
Fahrenheit.
Some days. Yeah, many days.
And this dovetails into oil demand.
Just perfectly.
It goes
through the winter months.
It's a perfect
the energy situation in Europe.
Amrita Sen is going to walk off the stage here if we don't get to her. Amrita Sen joins us right now, Director of Research at Energy Aspects, and she is wonderful on the microeconomics that gets you to $120 a barrel in Brent crude, or maybe $60 a barrel on Brent crude. Amrita Sen, to me, there's never been a greater time out of the GDP marked down by Goldman Sachs on China. The mystery of oil demand, to me right now, off the chart. Do you have a clue what oil demand is going to be this year?
Yeah, we think it is going to continue to rise and rise by about close to 3 million barrels per day. It's not going to be quite there, but yeah, close to that. China actually isn't going to be the biggest driver of growth because, you know, you've obviously still got zero COVID policy there. We don't necessarily think they're going to lift that anytime soon, but it is going to be the rest of Asia. Most of Asia hasn't actually had much of a summer driving season as we've seen in the West. Last year, a lot of parts of Asia was still in lockdown, or at least under some form of mobility restrictions. So you are already seeing a lot of strong demand growth numbers coming out of there. Of course, now cases are rising everywhere in the East. But once we are through this period, the summer should be very, very strong.
Amrita, what do you make of this Francisco Blanch of Bank of America call for $100 or plus oil prices by the second quarter?
I mean, our price forecast, which has been consistent for a few years now, we've been calling for $114 for next year. That's an annual average. So of course, it goes well above 120 next year. We don't necessarily see that this year, even though we are saying, and our models are showing that inventories globally are not just at a record low levels this summer. They're going to fall down to those levels, but they are going to be at levels we've really never seen, especially on a global basis, but especially in non-OECD countries. So yes, there are risks that prices go higher. I mean, our annual average for this year is 85, but The worry, of course, in the near term still is COVID. Demand is still hamstrung. OPEC still has barrels to give. So for us, the real spike in oil price story remains second half, like really end of this year into next year. The caveat to that is these supply outages. We've seen so many of them: Ecuador, Libya, Nigeria, Kazakhstan recently. If these keep mounting, of course, you can get to $100 earlier. But without those, it'll still be end of the year into next year.
How much are we underestimating the higher cost to actually refine some of the oil that's going to be coming online, especially in light of some of the other material inflation that we've seen around the world?
It's a great question, and something we've been accounting for in our balances. To Tom's point, in terms of the economics of it, it becomes very important. We are looking at cost inflation of at least 10 to 15% across the upstream industry, and that just means that, again, you need a higher price just for these producers to break even, because they need that much more in terms of their equipment and just for sustaining their production. So that's a minimum, 10 to 15%. In some areas, we're hearing about 20% inflation when it comes to oil services.
Amrita, just finally, how strong is our understanding of the relationship between, say, balance sheet reduction and crude prices, interest rate hikes and crude prices? The latter we have a ton of experience with, the former not so much.
Oh, absolutely. And I think this is going to be, again, if you talk about wildcards or, just events outside of the core fundamentals of oil impacting crude this year, it's going to be hugely important. Generally speaking, if we do enter a period of tightening monetary policy or even fiscal policy for that matter, we are going to be in a period of lower growth and by definition lower oil prices. But if that is accompanied with inflation, oil tends to perform very well in a high inflationary period. So that's your juxtaposition with that theory.
This is really tough. That's the bottom line. Amrita Sen, thank you, of Energy Aspects. That's the difficulty you have right now, Tom. And what you've seen with crude prices, when we have some really tough days around the equity market, yields higher, a conversation about higher interest rates, look at where crude is, still in at around 80 on WTI.
It has been persistent here at 80. And, again, I think the timeline here is really important in that, it's easy for financial media to make big headlines, OMG, $100 a barrel or even $120 a barrel. But the timeline here, it has to gestate. It has to work out. And, what I can tell you is the pros say so much of it hinges off China.
China right now, the GDP forecast from Goldman Sachs, Tom, I'm going to go through it on where they think that weakness will be concentrated. The negative impact is likely to be concentrated in the first quarter, with a rebound expected in the second quarter. So there's a cut to full-year GDP growth from 4.8% to 4.3%. But Lisa, they think it's concentrated at the very beginning of the year. First quarter, 2Q, we bounce out of that through the rest of this year.
And this does go to the whole demand picture for oil, since there's such a big consumer. But it also speaks to this broader shift, a structural shift toward greener energy that's removing some of the investment in crude, in fossil fuels. And how much does that play into persistently higher oil prices that leads to this inflationary, I don't want to say spiral, but,
Sure.
Spiral.
That Goldman call... Spiral. That Goldman call linked to the COVID treatment that we're seeing take place in China. By treatment, I mean restrictions. Another city being locked down in Hong Kong, more restrictions, another layer of them, more flight restrictions, schools closing. It's a difficult one for that part of the world right now. 10-year yields 176.75. Equities up 0.2%. Tomorrow CPI, Friday retail sales. Up next, the conversation with the brilliant David Harrow of Harris. Don't miss that from New York. This is Bloomberg.
wonder how all that chocolate makes it to the supermarkets in time for Christmas. I'm James Walcock, and I got really curious how chocolate makes its way to the supermarkets every Christmas. So I came here to Nestle's distribution centre to find out how it works. Almost 120 lorries come here every day, and they drop off coffee, chocolate, Kit Kats, Toffee Crisp, you name it. If it's made by Nestle, it will come through here, and it will get sorted by machines who will then load it onto a monorail that runs right up and down the facility. Automated cranes, like this one coming in behind me now, then load all of the chocolate, storage, all of Nestle's goods into this big warehouse. It can hold up to 100,000 crates. And then after it's been sorted and stored, sometimes for months, it will then end up over here, where then lorries will then take it out to supermarkets up and down the country. You can see the entire process is done without people. Goods can come and leave, sometimes without ever touching human hands. It's one of the largest automated centres in the UK, and it opened during COVID. So this Xmas is its first big test, and so far, it looks like things are going well.
Many people who are minorities don't any longer believe in the American dream. What do you say to these people about whether this country really still exists for the American dream?
The American dream is possible, but it is failing a lot of people because of some of these racial blinders that exist.
How fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City on TV and radio, this is Bloomberg Surveillance. Tom Keene, Lisa Abramowitz, and Jonathan Ferro. Your equity market up 9 on the S&P, up 0.2% on the Nasdaq 100, up 42, plus 42. Plus a third of 1%. Yields unchanged on 10s, basically unchanged on 10s at 176.57. Big conversation about the front end of the curve with 2s pushing higher again. Yields higher there by 3 or 4 basis points to 93 basis points, 0.931% on 2s. And the Atlanta Fed president this morning, Raphael Bostic, speaking to Bloomberg News and saying the following: if the numbers continue to come in the way they have over the past several months, I think a March liftoff would be appropriate. We'll be catching up, Tom, with the Cleveland Fed president, Loretta Mester, a little bit later this morning, 9:15 Eastern, on radio, on TV.
Not a routine conversation and a beautiful prep for the Powell hearings. Of course, you hear that on Bloomberg Radio, Bloomberg TV through the morning. Right now, and this is, when you have a booking team like we do, our team is just absolutely superb. Many of them are work from home. But it's just been absolutely superb. And we said to them, okay, you got to go out and get us a first-rate international investor and somebody, expert on European banking. But what we really need is someone who knows negative Celsius. And you get the Rolodex out, and there's only one name in surveillance land, and that's David Harrow, Packers fan. And David, in 2008, Giants-Packers, you were there, and it was a negative 31 Celsius wind chill. How cold was that game?
Well, it was pretty cold, and you got to cover everything up and make sure that as you're drinking beer that you had in your face mask, you needed a little thing so you could drink your beer, because that beer, of course, keeps you warm. You need beer.
Good. Johnny, you taking notes?
And you have to start the day with a bratwurst, because that is your fuel. So the beer is the antifreeze, and the fuel is the bratwurst. Pro und Senf.
Thank you for that analysis from balmy Chicago this morning. David Harrow, on international investment, the fuel is a weaker dollar. Are you going to get international equity performance singularly because you need a weak dollar. You need a weak dollar to make it work.
No, it's certainly been a headwind, by the way. A strong dollar has been a definite headwind over the better part of the decade, really. And now that the dollar seems to have peaked, perhaps that we could get some reversal of this. But that's just one of the factors that has impacted international returns. Has been the strength of the dollar. It has been a headwind. I expect that it will probably be a tailwind. But I think more importantly, areas like Europe coming out of the pandemic, ending the negative interest rate experiment will be even bigger drivers, especially given the valuation differentials between, say, European equities and the rest of the world.
So, David, let's push that forward into your call on European equities, especially as we get a headline this morning that the World Health Organization is saying that Omicron may infect more than half of all Europeans within the next couple of weeks based on how much the transmission rates are increasing. Is your view that Europe will actually emerge from this more quickly, will actually have a lower interest rate policy for longer, and will actually allow equities to outperform in a way that most people are not expecting?
Yeah, I think what will happen as this Omicron rolls through the world, and it kind of seemed to have triggered first in Europe compared to the U.S. And as you know, the Spanish prime minister said today, we got to stop looking at this as a pandemic and start just learning to deal with this with the flu. And eventually, the rest of the world will get this message. It looks like China is going to be the last one to get this message. But what will happen is they reopen the economy. And you finally are getting this synchronized reopening. This will be a major boost to the European economy, as it will be to the global economy. And European businesses really have a heavy export component to them. And so as the global economy reopens, I think you'll expect to see the European economy is almost a warrant on global economic growth because of the heavy export influence it has on their economy. And in the meantime, you have had these negative interest rates almost since post the financial crisis. I do believe this will be coming to an end as well, as the global financial system is fully capitalized. The reserves that have been built up over the decade the money earned can now be used to invest, to grow, to give to owners. So I do believe that it's going to be a better environment, that the tailwinds hurting investors in Europe and outside the United States, or the headwinds hurting them, will become tailwinds.
So, David, is the way to get the most out of that call to go into European banks?
I think that's one way. That is one way. I think this has been for a long time, and Tom's going to kid me because we've been stubbornly attached to these. Why? Because the price is low, and even despite those macro headwinds, they've been able to grow earnings. Now, albeit at a slow rate, but you have been able to see acceptable business performance despite the very poor macro conditions. Now these macro conditions are changing. And so I believe you'll see even a faster buildup of capital. Instead of that capital having to stay on the balance sheet because of reserve requirements, they're going to be able to use that capital. So you're going to see an increase in the velocity of money. And this is exactly why the central banks can't sit on their hands.
David, we got to turn to European banking. It has been a horrific 2021 for management, all sorts of stories. You've actually been knee-deep in this and very visible, and I'm sure at times invisible as well. Is European banking management becoming more Anglo-American, where they will really adapt to shareholder pressure?
I was just talking to your very good reporter and who covers this, Jan Heinrich Forster, by the way. And he, I think it's improved greatly. It has, if you look, I look across our holdings in Italy, Intesa Sanpaolo, and France, BNP. I mean, two of the best banking CEOs, I would say, in the world, and leading those two organizations. Credit Suisse, of course, which has struggled. Really struggled.
Oh, come on, David. David, I got to cut you off. Let's get to the chase. David Harrow, does Credit Suisse have to be put out of its misery?
What has to happen at Credit Suisse is they have to allow change to happen via the new chairman, Antonio Horta Osorio. if he is very capable, he stabilized and repaired Lloyd's, he's the exact answer to their problems. Now, to be honest, I think this is the last chance you. He is the answer to their problems. You need organization, you need...
Okay, traders, as you can see, it moved far away, basically, from the order we wanted to place. It just reached little bit, but we didn't have chance to fill the order. So we will cancel this order to sell short euro. If you guys manage to sell short, please place your stop according to our strategy, where it's supposed to be, and then collect your profit if it will move higher, or just move further your profit. For us, we'll cancel for time being our order to sell short, and we will wait for next opportunity to trade euro. Stay safe.
Simple. Banks make money, but the object is to keep it after you make it. And in Credit Suisse's case, they have not been able to keep all of what they've made because of poor risk control and poor legal and compliance, et cetera, et cetera. So if you can fix these things, all that money that has been made in the past that has been frittered away to fines and to losses will become gains for the shareholders. And I think this is what's important is, you know, the engine has been producing income. It's been coming in the front door, unfortunately, because of sour leadership and management. And I think, you know, it's been no secret. I think the past chairman of the business, who's been there over a decade, presided over all these legal incidents and all these market infractions. Now that you have proper top leadership at the top of the organization, I believe that this income that is generated can be captured.
David, you mentioned a word there, unfixable. What does unfixable look like? How do you know it when you see it?
When you continue to see losses and infractions and a lack of executional excellence and a lack of discipline. You need discipline, and especially in financial services where you have, in many cases, translucent or opaque assets. And you need to be able to control and manage risk. You don't completely eliminate risk. You have to look at risk reward. You have to price risk properly and balance it properly in order for a financial institution to be successful. And unfortunately, this is what Credit Suisse.
Yeah, David, we don't care. What we want to know, Aaron Rodgers, I mean, he's got a left tackle back, the gentleman from Colorado and Boulder, David Bakhtiari. Tell me on the importance of the line for Aaron Rodgers in that left tackle.
Well, Bakhtiari, of course, is critical. He's probably one of the best tackles in the league. And if you give more time to Aaron Rodgers, you know, that's like giving a sharpshooter, you know,
yeah.
He becomes even deadlier.
It's unbelievable. Thank you. John, I misspelled Aaron Rodgers. I'm going to go so much to the Packers timeout chair. I'm never going to be invited in Wisconsin again.
David, thank you. David Harrow
thank you.
of Harris Associates. Given how cold some of those games are, Tom.
Was that good enough, John, for you? Minus 31 degrees wind chill.
Give me a break. TK, let's get back to Credit Suisse.
Yeah, we got to.
It has been brutal. I think we were down plus 20% last year. David Harrow's been very, very patient through all of this, highly critical of management over the years, and here we are. It feels like, Tom, for the likes of David Harrow, this is the last chance for the C-suite at Credit Suisse.
I'll go with that. What I know is when James Gorman sees me at Davos, he turns around and runs because he knows I'm going to ask him about Credit Suisse.
Do you want to pick off pieces of it? Is that where you want to go, Tom?
Whatever. I just don't get it. It's been a struggle for 20 years.
Tom Keene, Lisa Bramett and Jonathan Farrow a little bit later.
R-O-D-G-E.
9:15 Eastern Time on TV and radio. Loretta Mester, the Federal Reserve Bank of Cleveland president.
I'm terrible at Wordle.
I'm interested in that interview.
Thank you, Lisa.
Anytime.
I'm pleased you are. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The US Senate is set to vote this week to impose tough new sanctions on the Nord Stream 2 pipeline. There is broad congressional opposition to the gas pipeline, which stretches from Russia to Germany. But some Democrats are concerned the sanctions would complicate ongoing talks between the US and Russia. Those discussions are aimed at order. President Joe Biden travels to Atlanta to push for passage of voting rights legislation today. Senate Republicans are vowing to block the measure, and some of the president's allies are complaining he hasn't done enough to advance it. The bill would prevent states from curbing access to voting. In Hong Kong, authorities are doubling down on their controversial COVID-0 policy. They are reimposing some of its strictest limits since the pandemic began. Kindergartens and primary schools will close yet again. Meanwhile, passengers from what are considered high-risk countries are set to be banned from transitioning through Hong Kong's international airport. Citadel Securities will get a minority investment in a deal that values the electronic trading firm at about $22 billion. Secure Capital and cryptocurrency investor Paradigm will invest more than $1.1 billion. Citadel Securities is majority owned by billionaire Ken Griffin. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the test strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is infected. We're going to be smarter, and we're going to pivot, and most importantly, we're going to defeat COVID.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm here at the Delhi airport, and behind me you can see SpiceJet's 737 MAX aircraft. SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
If you're able to withstand some of the pricing pressure, if you're able to withstand some of the supply chain disruptions, those are the quality companies that we want to be invested in. Take advantage of some of the volatility there, the volatility in terms of the rates increase, the volatility that we're seeing in terms of anticipation of earnings. Ironically, this volatility around tech is creating some opportunity for us.
This is really informative. You can see that out on Bloomberg Digital, folks, on radio and television. Kristen Bitterly was sharp yesterday with Citi Private Bank and the tumult of the times. It's a good to have Barry Ritholtz on, Lisa Bramlett and Tom Keene to get you to the top of the hour, and of course on to Loretta Mester with John Farrow and Michael McKee, and then Jerome Powell on the Hill and the soiree with the politicians. But right now, Barry Ritholtz, and he's done what Ritholtz is acclaimed for. Long before you knew him, we knew that Ritholtz had the courage to go out the x-axis, which means look at charts and do a compare and contrast. And your summary, Barry, which I thought was brilliant, is this is an aberrant and excessive 2022. How do I invest, allocate, put cash to work if I'm aberrant and excessive?
Well, that's a great question, and I think it's a two-step answer. The first thing that those charts reveal to me is how little we have the ability to know what's going to come next. In fact, most of the pundits and a lot of the analysts, they barely know what the hell's going on right now. How can you expect them to forecast the future? And it's one thing to say, well, nobody could expect an externality like a pandemic in first quarter of 2020. How do you explain the second half of 2020 or all of 2021? We already knew what had come, and yet they still managed to get a lot of it wrong. And so given that fact that humans are really bad at forecasting the future, making these little course corrections in your portfolio because you think you know what's going to happen next, that's a fool's errand.
Okay, it's a fool's errand, but I got to do something now. Are you comfortable in cash right now, Barry, or do you need to be invested?
So there was an interesting article in the Wall Street Journal yesterday about the fund management industry put up great numbers in 2021. They were up 22%. And when we analyze why they were about 400 basis points below the S&P 500, and if you include dividends, about 500 or 600 basis points, the key factor, or at least one of the key factors, was the cash they were carrying. Carrying excess cash in an up market is just a dollar for dollar drag on performance. And so unless you have any special insight into when the next time the market takes a 10 or a 20 or a 30% drop, enough to make up for the taxes that you're going to have to pay your partner in crime, Uncle Sam, playing that game, especially around the 5% pullbacks, it's kind of silly.
Well, Barry, what you're saying on one hand is fairly basic, that basically you can't time the market, you can't know what's going to happen, and you're going to just invest. On another level, it's incredibly radical at a time when a lot of people are saying this is the time for active management. Are you saying this is not the time for active management? People need to stick with their indexes and not try to be smarter than the commonplace logic, given the fact that there are so many unknowns?
So let me clarify that. When I say you can't time the market, what I'm really saying is for the vast majority of amateur investors and a very, very significant majority of professionals, market timing is all but impossible. There are a handful of people who have shown some skill, some ability, but they're the exception that proves the rule. The people who have gotten this right, you know, they're unicorns. They're really rare mythical creatures. And to assume that you're going to be the next LeBron James is kind of egotistical. So there's that. And second, gee, I've been hearing this for, I don't know, 10 years. This is the year where active management outperforms the index. And I guess if you say the same thing every year for eternity, eventually through dumb luck, you'll be right. But that's the classic broken clock problem. After 10 years of getting it wrong, hey, the one time they're going to outperform, it's meaningless over the long haul.
So what's the consequence of this from a market perspective, Barry? Because a lot of people have been trying to understand this flight to passive funds and what that means for an investment and, frankly, how efficient markets are. Does that mean that this is sort of the make it or break it year for active management? And after this, that shift to passive will only accelerate?
So first, there's I think a key thing that people misunderstand about the active passive debate. The vast majority of assets, stocks, bonds, real estate, are managed actively. When we look at funds and ETFs, now that's become a majority passive. So recognize that distinction. And second, the other thing that when I make these broad, grand pronouncements, I really have to remind listeners, not everybody has the same time horizon, the same risk tolerance, even the same investment targets. So if you're managing around the periphery of a portfolio and your job is to try and take advantage of volatility, I'm not speaking to that crew. That's a very, very different description than the typical mom and pop investor with a 401k or a portfolio that's a couple $100,000 or a couple of $1 million. For the most part, the more they do, the worse off their returns are. But that's there are professional hedgers. There are people who have very, very short time horizons, completely different advice to them than the typical investor who tends to get excited when they see volatility, and instead of taking advantage of it, exasperate the situation and make the returns worse.
Barry, I got to leave it there. We got breaking news. Barry Ritholtz, thank you so much here on the markets. And of course, this folds into what we'll see from Chairman Powell as well. There it is, Lisa. We mentioned China GDP and macro babble. Some industries, they got to deal with it right now. And there's United Airlines with a little bit of COVID.
Yeah, coming out saying about 3,000 workers in the company have contracted COVID. But they did say, and this is according to the United Air chief executive officer, that no vaccinated employees with COVID are in the hospital. And I believe that their employees are nearly almost all vaccinated as they try to get back up and running. But they're not alone. We have seen this consistently, Tom, with disruptions in the airlines because of people calling out sick. And it's not just the airlines, it's a lot of industries.
Certainly here in New York, it's got to be disruptive over at Newark as well, one of their major hubs. That's about 4%, 85,000 is the number on the Bloomberg of United employees. And Lisa, I guess just with news flow, we've got to set up here, not Loretta Mester so much, but how she manages what we're going to see afterwards, which is the theater of the Powell nomination.
And the theater is the right way to frame this, because you're going to see a lot of commercials being made, as Joe Matthew was saying earlier this morning of Bloomberg News, that basically there's going to be a lot of job owning. However, there could be some real news if Jay Powell gives an indication of how much disruption in markets he's willing to tolerate, or frankly even wants to see, as they try to get more transmission of a tighter policy through the economy.
And upfield goes to red and green in the screen right now. Futures flat, Dow futures ever so slightly flat. NASDAQ can't figure out what to do as well.
Well said.
10-year yield 1.77%. It's a churn to the market as we await a conversation with the president of the Cleveland Fed, Loretta Mester, with our Michael McKee and Jonathan Farrell. Please stay with us on radio, on television. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries, more than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Chairman Powell just around the corner from New York City for our audience worldwide. Good morning, good morning. S&P 500 futures totally unchanged. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
From New York, we begin with the big issue. Chair Powell heading to Capitol Hill.
Chair Powell.
Chair Powell. His hearing.
What he's going to talk about.
I'm going to be really looking forward to what he has to say, and so are members of Congress.
The Fed's in a tough spot.
They have a significant inflation problem on their hands.
Eye-popping inflation numbers. We're now looking at a 7 handle.
On the one hand, they want to appease financial markets.
But the compromise not breaking something.
On the other hand, you've got the public that's upset about inflation.
Naturally become political problem number one for the Biden administration.
It's hurting the majority party, the Democrats. Jay Powell.
He does have to thread a really tough needle.
You're getting tapering, you're getting rate hikes and potentially balance sheet runoff.
Transition from QE to possibly to QT.
4 rate hikes on the table.
A very, very delicate dance.
A brilliant lineup going into the opening bout. Joining us now is Citi's Robert Buckland, Invesco's Rob Waldner, and PIMCO's Tiffany Wilding. Tiffany, your outlook out this morning. We'll dig into that in just a moment. Just give me your expectations for Chairman Powell a little bit later.
Yeah, well, I think that, clearly a faster pace of a faster policy shift is needed in the current environment, and I think it's going to be really important how that's communicated from Powell today and how it continues to be communicated. And of course, that any shift in policy has the potential to create market volatility. So Chair Powell, of course, has a heavy lift in front of him.
Robert Buckland, same question to you, sir.
Yeah, it's a tough balance for him to navigate. He's sort of got to tell the markets what they want to hear while telling Congress what it wants to hear, and they're not always the same thing. So I don't envy him his job today.
Rob Waldner, I don't think anybody does. This one could be heated. I think the outcome's widely expected. He gets a second term. Rob, you think real rates get back to zero in 6 months. I'm just wondering how disruptive that's going to be.
Well, I think if you go back and you look at last time we were at a fully and sort of normally functioning economy, we had real rates at zero at the end of 2019. I don't think for economic-based activity and for the parts of the risky assets which are really based on earnings and growth, that's really a problem. I mean, I think that the taking liquidity out of the system that the Fed is likely to do going forward with rate hikes and reducing the size of the balance sheet will hit some assets that are liquidity driven. But I think for the fundamental, for the overall growth and for the fundamentally driven assets, it should be okay.
Tiffany, just going through your cyclical outlook that's just out this morning, one of the lines in there that got my attention, our base case has global inflation peaking by the first quarter and then moderating closer to our central bank targets by the end of 2022. Given where the data is right now, Tiffany, that feels really, really quite optimistic. Why is that your base case?
Well, I mean, I think ultimately, this sort of what we've called Goldilocks scenario of slowing yet above trend growth, supply coming back online this year, so moderating inflation. I think it's still reasonable that that's the base case. But as we also highlight in the piece, I think what's going to be more important for markets, is that the combination of factors that we're dealing with right now. We would argue the United States, like other developed markets, is rapidly progressing towards the later stages of a cycle. That requires a policy shift, as I mentioned before. And policy shifts can create volatility. And that's also one of the risks that we see is that you get elevated inflation or you have a Fed that's overreacting, to the current inflationary episode. Either way, that can create some animosity in markets.
Well, certainly your forecast is what Chairman Powell wants to see at the end of this year. Going into this testimony, this hearing a little bit later, this is what he had to say. We will use our tools to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. Mike McKee, the man himself, speaks in about 55 minutes' time.
And he's got a problem to address, as was just mentioned. The Fed chairman is going to have to talk about what's happening with inflation. It is going to be the #1 issue for politicians who have to get reelected in November. And the CPI comes out tomorrow, expected to print at 7%. That would be the highest since 1982. Ronald Reagan was president. Paul Volcker was chairman of the Fed. And we know what happened with interest rates then. So where does he go from here? Well, markets now see 4 rate hikes for 2022. That might be ambitious because the Fed is also talking about earlier balance sheet reductions. How much is that worth? 25 basis points, 50 basis points? Depends on when they do it and how quickly they do it. And then how do they change their forward guidance? They had been saying we got to wait until we reach our goals or it's obvious we're going to make our goals. But then if they don't make their goals, what does the Fed do next? What does he tell them about what's going on? And here's the interesting thing. The Fed has moved up its dots at the last meeting. The market has moved up now to 4 rate hikes by the end of 2022. But look at that terminal rate all the way to the right. That's the neutral rate the Fed sees. That has not changed, 2.5%. And the markets, the break-evens, John, are showing basically the same thing. The Fed is going to be able to control this. A lot of people out there worrying about recessions, the Fed going too far. But that's not being priced in right now. We'll see what happens after Jay Powell speaks today.
We've got to talk about that. Mike McKee, looking forward to our conversation. In about 10 minutes' time, we'll catch up with the Cleveland Fed President, Loretta Mester. Don't miss that on Bloomberg TV and on Bloomberg Radio. BlackRock's Wei Li has this to say on the Fed. What really matters is that the Fed has kept signaling a low sum total of rate hikes, and that didn't change in the past few weeks. Rob Walden, I want to come to you on this. Just exactly what is the Fed signaling right now?
Well, I think the Fed is in transition, right? Because the Fed is independent, but that doesn't mean it's free of politics. And if you look at the risk within the political environment in the U.S., until recently it was towards getting everybody back to work, getting full employment, getting wages up at the low end of the income spectrum. Now I think that's changed, and the rhetoric from the administration is making it quite clear. They see the biggest risk in 2022 is inflation. And so I'll be very interested to see the questioning today of Chair Powell around this inflation, because I think it's becoming political job one to do something about inflation. And I just don't see how the Fed will be able to stand against that force of wind.
The CPI estimate going into tomorrow, 7.1% so far in our Bloomberg survey. There's been a big reaction in the market to start the year 2022, and JP Morgan is already saying buy the dip. The pullback in risk assets in reaction to the Fed minutes is arguably overdone. Policy tightening is likely to be gradual and a pace that risk assets should be able to handle, and is occurring in an environment of strong cyclical growth. Robert Buckland, can you respond to that? Is it overdone, what we've seen in this market, not just in the US, but worldwide?
I'd like to see a dip first, right? Does this really count as a dip? I don't think so. So I get all this buying the dip stuff, but the kind of sell-off that we've seen in the first 3, 4, 5 days of this year doesn't count as a dip to me. I'm thinking about something more like 10%, and yeah, fine, that's not a problem. But what we do know is that there is a major hurdle for all financial markets to deal with potentially in March of this year, which is the first upturn in the US rate cycle for 6 years. I suspect that's where perhaps the proper dip will happen, and yeah, we'll look at it then.
Robert Buckland, you're waiting. Is that the message to your clients right now? Wait.
Yeah, I need it to be a dip first before I tell them to buy it.
I think a lot of people share that view. The Nasdaq has been brutal. Let's be clear about that. Tiffany Wilding, to come back to you, a conversation I have with Loretta Mester, the Cleveland Fed president, in just a moment. Mike McKee and I are trying to understand the relationship between the balance sheet and rate hikes. Do they complement each other? Does the balance sheet replace some rate hikes? How do you navigate that? How do you look at that situation?
Yeah, well, I mean, I think it's clear that reducing the size of the balance sheet, is a form of monetary policy tightening. Of course, there's more uncertainty around just how that affects broader asset prices relative to interest rates. Of course, the Fed has had a lot of experience changing the interest rate, so they have a better handle on that. But overall, there are estimates for this, and it would suggest, starting to reduce the size of the balance sheet later this year, as we expect, would account for some additional tightening in financial conditions. We sort of estimate that it could be worth 2, maybe 3 rate hikes. But I think, again, I just want to underscore here, there's a lot of uncertainty around that, and markets can overshoot. And again, that's one of the risks that we've highlighted. It's clear that financial conditions, they should be tightening. The U.S. as well as other developed market economies are strong, and that necessitates, somewhat a shift from the easy financial conditions that we've seen. So just how quickly the markets, tighten financial conditions, whether that's abrupt or more gradual, will be important considerations for all of this.
Rob Waldner, can I get a final word from you on that? Final word, please.
Well, I think that, what's happening here with the Fed and what worries us is that what we call flip the script. So politically, the Fed has, and we don't know how much QT is worth. Let's face it, we really don't know how to equilibrate QT to rate hikes. And now we're talking about doing these things all at the same time, not in a much more compact time. So I think the potential for risks and for mistakes is growing.
Big year ahead for the Federal Reserve. Rob Waldner, Robert Buckland, Tiffany Wilding sticking with us. Coming up on the program, the Fed's rate hike path taking center stage.
I think they should go faster than what's priced into the market. I mean, obviously, it's going to depend a bit on how the economy evolves. But my best guess is, they need to do at least 4 or 5 rate hikes this year. And it wouldn't strike me at all if we get into an every meeting kind of cycle at some point.
A massive call from Bill Dudley, the former New York Fed president. More on that still ahead. Plus, our exclusive conversation with Cleveland Fed President Loretta Mester from New York. That's coming up next, live on Bloomberg TV and radio. This is the Countdown to the Open.
EVs coming to market. And I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share would expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, been fast has put in about $6 billion so far into VinFast, and we plan to have a few more $1 billion investment.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Live from New York City for our audience worldwide, about 17 minutes away from the opening bell. Let's whip through the price action for you on the equity market. Futures slightly negative, down a tenth on the S&P, all over the place on the Nasdaq. The Nasdaq 100 down 33 at the moment, down marginally, off by 0.2% after the monster moves. The big turnaround in yesterday's session. Bond yields a bit higher on 10s, on 2s much more, up 5 basis points on a 2-year yield. From New York City, a special welcome to our TV and radio audience worldwide. Bloomberg's Michael McKee alongside us. Happy to say, joining us both, Cleveland Fed President Loretta Mester. President Mester, always fantastic to catch up with you. You know the setup right now. We've got Deutsche Bank, Citi, JP Morgan, Goldman, all calling for rate hikes in March. Some of your colleagues doing the same. What obstacles are left, if any, for making a move that soon?
Well, you know, the economy is on a really good track. The inflation numbers are high. It looks now that inflation is more persistent going forward. Early in the pandemic, earlier, you know, in the last year, a lot of those price increases were really on things that were really tied to the reopening of the economy and the supply chain. Now those price increases have broadened. So if the economy in March looks like it does today and the outlook is similar, and of course, there's uncertainty around that. But if it does, then I would support moving the funds rate up at that meeting and starting to move back from some of the extraordinary accommodation we needed earlier in the pandemic. And, you know, I just want to point out that even when we make that first rate move, whenever it is, that's not really policy tightening. Accommodation is still going to be really high at that point. So, you know, I think that the case is really strong to begin to wind back some of that accommodation.
Well, that raises the question for our friends on the trading floor of how far, how fast, and where do you stop? Bill Dudley says you probably need to do 4 or 5 rate moves this year. You've long been an inflation hawk. How far do you think you need to go?
Well, I can tell you in the December SEP submission, I had 3 penciled in for this year and a few more over the trajectory. But I also want to point out that, you know, we're going to have to see how the economy does over time before we can say for sure how many rate increases are needed. You know, there's still a lot of uncertainty around the outlook. There's uncertainty about how the pandemic plays out. As we've seen each new variant, the economy has really navigated it in terms of the economic outlook. But right now, you know, we have to say that we probably need to recalibrate our policy stance because inflation is well above where we need it to be. The employment markets, you know, labor markets are tight from the standpoint of a policy relevant framework. Do I think we'll see labor force participation move up somewhat after we get beyond the pandemic? Of course, but I don't think we can ignore the shorter run or medium run tightness in that labor market. So I think we're in a good place to move policy, and, you know, we'll have to see how that affects the economy going forward and the other factors affecting economic growth and employment going forward.
Well, speaking of moving policy, the Fed's statement of principles says that the interest rate, the Fed funds rate, should be the primary tool, but you also have a lot of bonds on the balance sheet. How does quantitative tightening, to use the market term, fit into your thinking? How much would that be worth in terms of additional tightening, and when do you think that should be done, if at all?
Yeah, so I mean, we have a little bit of a playbook from the last time, but I think this time is different in the sense that we basically have a much larger balance sheet than we did because we had to do those asset purchases at the start of the pandemic because of financial market conditions being the disruption of the financial markets. We really needed to make sure that the financial markets continue to function. Now that additional liquidity is serving as a accommodative policy tool. We also have a much stronger economy now. So, you know, I think we'll be able to allow the balance sheet to run down much faster than we did last time because of those two factors, and adjusting, you know, how far to go and how we're still considering that. But I do think that it's good to look at sort of the policy tool, the interest rate as our main tool, but to take into account that we also are going to allow the balance sheet to run down. I mean, we doubled the balance sheet over this pandemic period, and I think we can bring it down also to support less accommodative monetary policy stance. And we'll have to see. I mean, frankly, there's a lot of estimates out there of what happened the last time we did quantitative easing and then tightening. But the pandemic is a different environment, as we've seen the whole time, right? I mean, we just don't know kind of what those effects will be, and we'll have to keep monitoring that. But that's kind of what we do always when we're doing monetary policy. We always sort of think about, we take an action, then we look at the data. We're very data dependent. We're very, looking at the current economy and then what's on the horizon for the outlook, and then we take into account the risk around that outlook, and then we recalibrate our policy. And we're going to do that this time, I'm sure.
President Mester, just to get some more clarity on that, I think this is important. Do you see balance sheet reduction as something that runs passively in the background alongside decisions you make separately on rate hikes, or is it something that supports the rate hike effort? Mike and I are trying to work out whether balance sheet reduction reduces the need for further rate hikes at some point as well. How do you think about that dynamic? Is it something that runs off in the background passively, or something that you think about together alongside interest rate hikes?
Well, I'm going to answer your question in a way you're not going to like, both, right? I mean, my kind of way I think about it is I'd like to sort of set sort of a path for the balance sheet, communicate that in advance to the markets. That will, reduce accommodation, and then we'll use our policy tool, the Fed funds rate, as our active tool. But, sometimes we have to recalibrate. As you saw, we did that in November and then the December meeting. We started with a tapering of the asset purchase program we announced in November, and then in December, the committee sped that up. And that may have to happen over this period as we calibrate. But in general, my approach would be come up with what we think is the right plan for that balance sheet, have that happening, and then use the policy tool as our main tool of monetary policy.
A couple of times in this conversation already, you've used that phrase, reduce accommodation. When we heard from Bill Dudley yesterday, he talked about the fantasy land of dovish forecasts at the Federal Reserve. And I just wonder, do we need restrictive policy at the Federal Reserve? Do we need to get away from talking about reducing accommodation and talk about outright having a restrictive policy stance?
So I don't think we need to do that at this point. I think that that's got to be on the table of, where is the end point. But, when we do our SEPs, it's 3 years away. And as we've seen, the economy can change in ways that are very unexpected. So again, at this point, I think it's really important that we take actions to bring inflation down, given the environment. And, a lot of times people think, oh, you're either for maximum employment or for, lowering inflation. And I don't see them as opposing one another.
Well, President Mester, forgive me for jumping in. How do you reduce inflation without a restrictive policy stance, without tighter financial conditions? How does that work?
Right, because the markets are reacting, right? So we've already seen some tightening in financial conditions in the market. And so, I think what we have to do is we have to bring our policy rate in line with the economy and where we want the inflation rates to go. And we're going to have to take actions to do that. So right now, if you look at long-term inflation expectations, you may take some comfort in the fact that they're basically maybe a little elevated, but around our 2% goal. I don't take that much comfort in it because that's based on, the Fed taking appropriate action. So it's incumbent upon us to take those actions. And I think we're in a good place to do that now.
Well, you said that we need to see how the economy develops before you know what you're going to have to do in total. But the pessimistic view expressed by a lot of people, you know who they are, is that you've waited too long, you're behind the curve, you're going to have to move too far too fast, and as the phrase goes, you'll break something, maybe send the economy into recession. How do you reassure people that won't happen, given that the Fed's track record in this area isn't very good?
Well, I don't know whether the track record is that bad. I mean, I think that the last cycle proved that we kind of navigated that pretty well, and that we had a very, very long expansion, right? A historically long expansion. So this is a pandemic environment, new things. We're going to look at the data. We're going to make sure we're focused on meeting both of our goals of maximum employment and inflation. It seems clear to me now that inflation is too high. And labor markets are strong, and we need to take action. And as the economy moves, we will take appropriate action to make sure that we're doing what we can to keep the economy on a positive trajectory. And that means taking actions to bring inflation down without, right, harming the positive trajectory of the economy. And that's going to be a challenge. There's no doubt about it. That will be a challenge for us, but that's what we do. That's what we're charged to do, and that's what we'll be doing.
Let me shift gears a little bit and anticipate a question from Elizabeth Warren, Massachusetts Senator, to the Fed Chairman, Jay Powell, today. We've seen 2 Fed bank presidents resign. We're now seeing the vice chairman resign early. Does the Fed have an ethics problem?
I do not believe we have an ethics problem. I think what happened was there was illumination on things that gave an appearance issue, right? They were technically correct in terms of the rules, but it was the appearance issue. The chair and the Fed are taking actions to strengthen the rules upon which we have to abide, and I think that is addressing the situation. I do not believe there's an ethics issue at the Federal Reserve.
President Mester, final question from us. Every cycle for the past few cycles, the Fed funds rate has peaked at a lower level. Do you think the dynamics are now in place with this economy that give you reason to think that might not be the case this time?
Well, I mean, partly that's what we've just been talking about, is how far do we need to go in order to recalibrate policy to meet our 2 mandated goals. But I also want to point out that the factors that held down inflation over the last cycle, globalization, technological change, demographics, they're probably still in play in the economy. It's just that they've been swamped by the supply chain issues, the high accommodation that's in the markets right now, labor market issues that keep people out of the labor market. So all of those things, right, are now front and center. Eventually, we'll probably get back to a low interest rate environment.
Loretta Mester, the Cleveland Fed president, thank you very much for being with Mike McKee and myself this morning. Thank you.
My pleasure.
Mike McKee, it's a difficult spot for this Federal Reserve right now. As we know, Mike, there's been a massive pivot over the last few months, and that's set to continue through the next 12.
Yeah, they changed their framework. They decided to run the economy hot, risk inflation to get unemployment down. Unemployment's down. We have inflation. Does the framework work? Can they get out of this?
Do they need tighter financial conditions, Mike? I mean, that's part of the conversation. They keep talking about removing accommodation. Do you think this is an economy right now that needs any accommodation whatsoever from this Federal Reserve, given where growth is, real GDP, and given where inflation is and could be tomorrow morning?
It certainly appears like it doesn't. I mean, demand is very strong. The question for the Fed that they have to try to figure out is when the fiscal stimulus money is gone, when people have used up their savings and we don't have as many people working, are we still going to have a lot of demand in the economy, or are things going to start to slow down?
And Mike, the clarity that we need, we got a little bit, but not a lot. The balance sheet reduction, how it complements, supports, runs in the background maybe around interest rates. Do you think they've figured that out yet?
I don't think they have a complete answer yet, but the idea is that they maybe can help control the yield curve, the long end, by using the balance sheet and use them in tandem. How exactly they do that remains to be seen.
Mike McKee, thank you, sir. Looking forward to more coverage from Mike as we count you down to testimony from Chairman Powell at the top of the hour. His reconfirmation hearing just around the corner. Your opening bell just around the corner too. From New York City, with futures unchanged for our audience worldwide, this is Bloomberg.
SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
23 seconds away from the opening bell in New York. Good morning to you. Price action set up as follows. On the equity market, we're down just 2 on the S&P, negative 0.04%. On the Nasdaq, where all the price action has been over the last 24 hours. On the Nasdaq yesterday, negative 2.7%. Turned it back round into positive territory. Right now, down 39 and negative 0.25%. There's the opening bell. Switch out the board and get to the bond market. Going into Chairman Powell. Going into CPI tomorrow. 7 handle, widely expected. 177.28, yields higher by about a basis point, yields higher on the year by more than 25 on 10s. Euro dollar 113.25, unchanged there now on crude, up by more than $1, advancing 1.6% to 79.46. Around the opening bell on the S&P, we are basically unchanged. Top of the pile, energy and financials. How many times did we say that last year? Energy stocks up 0.4%, financials up by 1/3%. And speaking of yields on 10s higher by a basis point, on 2s, we are up by 4 to 0.937%, pushing higher and pushing back towards 1 full percentage point. Still with us, Robert Buckland, Rob Waldner, Tiffany Wilding. Tiffany, I imagine you heard there from the Cleveland Fed President, Loretta Mester. They keep talking about removal of accommodation. They're not talking about a restrictive stance. That's not just semantics, not just words. What does that mean to you, Tiffany?
Yeah, well, I think that the focus here from Fed officials is basically that policy accommodation is still extraordinary, extraordinarily easy. So their focus right now is actually on getting that accommodation back to neutral, getting monetary policy back to neutral. So they're not even thinking about taking policy in restrictive territory, i.e. above neutral yet, because I think as President Mester suggested, they want to understand how the economy evolves and reacts to their actions. So they're going to continue, they're going to continue along this path of removing accommodation, getting monetary policy back to neutral, see how the economy evolves from there, and then decide where to go.
Tiffany, where is neutral in this economy?
Yeah, and I think that this is why you want to kind of you want to move policy in that direction and see how the economy progresses, because there's a lot of uncertainty around that. We just had obviously one of the biggest recessions in modern history, and although that's been followed by one of the fastest recoveries, there's a lot of uncertainty around the structural change in the economy as a result of this pandemic. So we've seen higher levels of productivity and investment in the United States, but of course there's also higher levels of savings out there, at least in private hands, household balance sheets. So it's really unclear, kind of where that neutral level is. And as a result of that, we've said that we think the terminal rate this cycle might even be similar to where it was our past cycle, or it could even be lower because frankly stuff happens once the Fed starts to remove accommodation.
Rob Wallner, this is why this is so difficult at the moment. You asked that question. It sounds simple. It's so hard to answer. I've heard people say it could be lower, it could be higher, it could be where it was the last time. Where is it?
So this is the point, Jonathan. It's very hard to know. For all the points that Tiffany laid out, it's hard to know exactly where it is. What the Fed is supposed to be doing is gently trying to find that place. And if they started a while ago on that journey, they could probably take that in a gradual fashion and look to find that place. What I'm a little bit afraid of is that President Mester did tell us that the labor market is tight, I think she said, and that the inflation is growing. So this is an environment where they've met their targets. And I think when the political pressure comes, there'll be very little to keep them from moving more aggressively. They will be biased to move more aggressively given the current environment. And I worry that will cause us to cause something more like 2018 to happen, where as growth slows towards the end of the year, they're actually ramping up tightening. And that mix of slowing growth and ramping tightening could create noise within the market.
That would be a huge concern if we went to the back end of December where the credit market, high yield of the primary market totally froze up. Robert Buckland, the key to last year was not the Fed. The key to last year was earnings, it was margins, and margins held up despite high inflation here in America. Is 22 going to be different?
I think it's going to be a bit tougher. You're absolutely right, Jonathan. We had a kind of two tailwinds last year, which was the Fed keeping the taps open and earnings being very, very strong. Earnings were up 53% globally last year. Our forecast, I get lots of things wrong in this business, but I've really got the one wrong a year ago. Our forecast just a year ago was 25-30%, and we were more bullish than everyone else. I think that 53% number is more likely to be 6, 7, 8, something like that this year. So the tailwind from very cheap money, I don't see that being here this year. And then the tailwind from continued earnings upgrades, I don't see that being here this year. And yeah, one of the things I'd point out to your listeners and so on the show is we hear this sort of fairly bland statement, tightening financial conditions. That means markets going down. Let's not forget about that, right? Tightening financial conditions means markets going down, just as loosening market conditions means markets going up. I think markets are going to struggle to digest initially the first hikes that we're going to see.
Markets going down. The question, Robert Buckland, which markets? Do spreads need to go wider? Is it treasury yields higher? Is it equities lower? That's the conundrum.
As you know, Jonathan, I'm a simple equity guy, so let's keep it to the equity market. I mean, we run these sort of simple models which show you that you can explain 90% of the valuation of the US tech sector using US 10-year real rates. Now, if we were to move US 10-year real rates to the kind of number that our rates strategists are forecasting, -0.25%, remember, it's -0.75 right now, that would imply the NASDAQ, the US tech sector, which is currently trading at 28, 29, 30 times, trading somewhere near 23 to 24. So 23 to 24 is still pretty high, but it's not 28 or 29.
Just to be clear, just here, Rob Wallner, just to come back to you, when you say zero real rates in 6 months, you talking about the 10-year?
Yeah, we're talking about the 10-year.
The 10-year. So let me just go back to you, Robert Buckland, and just use that as an assumption and walk me over what you just walked us through just moments ago. If we went back to zero on real rates in 6 months, what would that mean for this market, for tech stocks specifically?
Yeah, that would put them. Yeah, that would put the Nasdaq on 20, 21 times. We're not as bearish as Rob is on the real rate going up to zero. We're at -0.25, but that would bring. Yeah, that's consistent if we were to use the relationship over the last 3 or 4 years with the Nasdaq trading nearer 20 times and the current nearer 30 times.
Yields high this morning. On nominal yields, at least on 2s, up 4 basis points to 93, let's call it 94. Up almost a basis point on 10s to 176.93. On the equity market, lower again on the S&P, down 0.2%. The S&P on track for its 6th consecutive session of losses amid rising rates and inflation fears. Let's bring in Kaylee Lyons for more. Hey, Kaylee.
Hey, John. Well, that's the story in the S&P. When it comes to the NASDAQ 100, you actually saw it snapping a 4-day losing streak yesterday and really incredible intraday trading. At one point in the Monday session, that index was down 2.7%. 0.5%. It then actually ended the day about 0.1% higher. That is its biggest intraday recovery going all the way back to March 23rd, 2020, which was, of course, the day the Fed swooped in to save the equity markets. And, of course, yesterday's move also technically significant in that we saw it bumping against support around that 100-day moving average, something we've seen it test several times over the course of 2021. And as for the story in 2022, we've seen a real rotation out of tech underway. The broader information technology index is down the better part of 5%. Software and services really lagging within that. It's down 6 percentage points year to date. At the same time, the cyclicals are outperforming. Energy and banks up 10.5% and 9% respectively. Of course, we'll see if the banks in particular can keep that up as they start rolling out earnings later this week. But obviously that sector has gotten a lift from what you were just discussing, and that is higher treasury yields. Really, it's the rate story that has been driving the story for risk assets broadly in 2022 so far, as the 10-year has moved up more than 0.25% over the course of just over a week, putting pressure on richly valued stocks and really risk assets across the board. One of those being Bitcoin, which is now down the better part of 40% from its peak. That was back in November, John.
What a move. Kaylee, thank you. If you're just tuning in for our audience worldwide, just moments ago we caught up with the Cleveland Fed President, Loretta Mester. Take a listen to what she had to say.
There's still a lot of uncertainty around the outlook. There's uncertainty about how the pandemic plays out. As we've seen each new variant, the economy has really navigated it in terms of the economic outlook. But right now, we have to say that we probably need to recalibrate our policy stance because inflation is well above where we need it to be. We're in a good place to move policy.
Tiffany, I want to come back to you. Here's an individual on the Fed who said just 10, 15 minutes ago, I've penciled in 3 hikes for the year. When it comes to the economy and the new variant, which she referred to just there, Tiffany, I'm seeing China closing cities down, a second city locked down. I'm seeing additional restrictions in Hong Kong. Goldman this morning cutting their forecast on the world's second largest economy from 4.8 to 4.3. How are you thinking about these things in your cyclical outlook? What does that mean for what happens here at home?
Yeah, I mean, I think to your point on China, I think there's elevated inflation risks around, the rise of this variant, and the reason for that is because the Chinese policymakers have a zero COVID policy, zero case policy, and that is resulting in them having much more stringent restrictions around outbreaks. So, what does that mean? Well, that means that there's a higher likelihood that production is disrupted, across the supply chain once again. And as we've seen over the last year, that has been very important for the inflation outlook, not only in the U.S., but in other developed markets. So I think this just creates a much more uncertain path for inflation. There's clearly upside risks here. And I think that's in a little bit, I think those risks to inflation are a little bit higher than maybe some of the downside risks to growth as a result of this. Also for the reason that President Mester suggested, in that, folks within the United States and other developed markets are learning to live with this. So the type of demand disruption that we're seeing at home as a result of these kinds of outbreaks, that's, becoming, kind of reduced. Although we are starting to see in high frequency data, travel services and things like that at year end, restaurant activity, that started to deteriorate. So we do think we get a soft patch for growth in the first quarter. But again, I think the risks here are really towards higher inflation. Robert Buckland, just going through your global slowdown call, the headwinds ahead in your most recent note. Your forecast for global real GDP plus 4.2 in 22 versus 5.6 in 21. Downgrades to China, Eurozone GDP in the last few months. Only Japan expected to accelerate. Robert Buckland, when you think about the global equity story, the global equity picture, what does all of that mean for where you want to be?
I quite like the Japan story, Jonathan. People don't like negative deltas, and by that's awful market jargon for something slowing down, right? And the one area of the world, the major economy I can see in the world that's accelerating in 2022 is Japan. So that's one of the reasons we're overweight Japan. It's also the only major equity market where we expect double-digit earnings growth this year. So for people who are starting to get scared of the noises coming out of the US, of what the Fed is saying, and the things that you're concentrating on, we quite like the diversification and different story that you can find in Japan right now.
Rob Waldner, final question, final word on the global backdrop.
Well, I think what Robert Buckland just said is correct, which is that we have a slowing global growth environment as we come back to more normal growth patterns coming out of this big recovery after the COVID correction. So we'll be slowing, but it is still for now above trend. I think that the early part of the year is going to be fine because we have still good, solid upward momentum coming out of this slowdown. I worry about the tail end of the year, where I feel like central banks will really get the bit. At the same time, the growth will likely be continuing to slow. You know, we expect growth in the U.S. to be about 2% on a run rate by the end of the year.
Rob Walder, Robert Buckland, and Tiffany Wilding. Guys, thank you. Thanks for working through the up and down with me. I appreciate it. Coming up on this program, China sticking to its zero COVID plans, sending a second city into lockdown.
China and other countries like New Zealand and Australia have tried this COVID zero policy with, I think, disastrous results.
That conversation up next from New York. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number. And most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood changing, the confidence boosting aspects, so the sort of tribal aspects of what fashion does.
Omicron has presented an unprecedented challenge.
This virus is not leaving the planet.
The peak with Omicron is probably happening.
The protection that you're getting after national infection doesn't last as much as with the vaccine.
There's a lot of pent-up demand for our vaccine.
It's mostly unvaccinated people that are hospitalized and that are dying right now of Omicron.
This is a drug that should and has shown that it works against the variants. We're going to have 3 million courses to the U.S. by the end of January.
We have a really good vaccine, coupled with the fact that it's very tolerable.
The world should be in a better position with tests as we move forward.
We might end up in a world where it might be for people at risk an annual booster.
The same pandemic, very different responses. China's zero COVID policy putting fresh strain on its economy. The country locking down its second city. Meanwhile, in Hong Kong, reimposing some of its strictest curbs. For more, let's get to Damien Sassower of Bloomberg Intelligence. Damien, you and I have been following this story. The world has. Goldman out this morning, cutting their forecast for China GDP. A lot of that concentrated in Q1. I imagine you're thinking about the same thing.
Yeah, justifiably so. I mean, let's put some numbers behind it, Jonathan. I mean, Anyang, which is the second city that Beijing closed down in as many months, Xi'an being the first, is a city of 5.5 million people. 5.5 million people. Xi'an has 8.4 million people. I mean, Chicago, by comparison, 2.7 million people. So these are huge, huge cities. And obviously with the Olympics coming up, I mean, just to be clear, you know, Tianjin, which is under the big port city in northwestern China, is also under a partial lockdown. That's 13.8 million people. So again, China is really tightening the reins ahead of the Olympics, which are coming up in less than a month. And of course, the spillover into the rest of the world through supply bottlenecks, inflation growth can't be underestimated. Yes, we are looking for GDP growth of under 5% year over year this year.
Under 5. And Damien, it's not just the scale of the cities, the size of the cities, it's what it takes to shut them down.
Oh, yeah.
You think about Hong Kong. This is the stat I've been looking at this morning over and over again, just to make sure I'm reading it correctly. I read it multiple times. Carrie Lam, the chief executive of Hong Kong, said the city has tested around 920,000 people over the past 2 weeks. Guess how many positive cases they found? 42. 42. Can you imagine the same thing happening in America?
And they're closing primary schools and bars and beauty salons, and they're closing them until after the New Year. Remember, the New Year in China is the 1st of February. It lasts for 2 weeks, so children aren't going to go back to school in China until the middle of February. I mean, this is serious stuff. So, Jonathan, yes, we agree with you. I mean, this is all stuff to be watching. But look, you know, the PBOC seems like it's erring on the side of caution here. It is trying to loosen liquidity. We did see the triple R cut. We did see the loan prime rate cut. So, you know, are more expected? We think so. We think another 50 to 100 basis points of rate cuts are expected in the next, call it, you know, 3 to 6 months.
Wow, amazing numbers. Damien, always going to catch up with you, sir. Damien Sassower, the level of tolerance in some way, and not exclusively because they've had this zero COVID policy for a long, long time. The vaccine coverage in places like Hong Kong, a massive issue, particularly for the older cohorts of the population. In China, the vaccine itself, less dependable, less reliable than, say, the vaccines we talk about here in America. That's the story in China. Here's the story between the US and Russia. Officials vowing to continue discussions with the first round of talks failing to resolve differences over Ukraine. Deputy Secretary of State Wendy Sherman saying the following: "We were firm in pushing back on security proposals that are simply non-starters for the US. We will not allow anyone to slam close NATO's open door policy." Bloomberg's Anne-Marie Hordern down in D.C. now. Morning, Anne-Marie.
Good morning, John. As you said, nothing concrete coming out of those Geneva talks. The sum of it is that there will be more talks. And in this high-stakes situation, even the fact that there's appetite from Washington and Moscow to continue a dialogue is optimistic. You read out what Deputy Secretary Wendy Sherman, her counterpart in Russia, Deputy Foreign Minister Sergei Ryabkov, here's what he had to say following the meeting. "Our business-like and professional dialogue, of course, makes us more optimistic, but the key issue remains unresolved. The situation is so dangerous that we cannot afford any further delays in resolution of this fundamental question." And then this morning, Jonathan, we heard from Kremlin spokesman Dmitry Peskov, and he says what is going to be able to judge or characterize these talks is going to be the remainder of the week. So what comes next? Following Geneva, there's NATO discussions with Russia in Brussels, and then larger security talks that are going to happen in Vienna. So it still remains a high-stakes situation. We heard yesterday from Jake Sullivan, the president's national security advisor, saying there is still this threat as Vladimir Putin, the president of Russia, continues to build up now more than 100,000 troops. But Jonathan, there's one data point that I would like to bring up, because if you go to Russia, this is something that people who are there could really understand. In 2014, there was mass rhetoric across Russian state TV about Ukraine. Now, in spring, when President Vladimir Putin again had a buildup, that rhetoric really started to die down. And we are seeing the same thing happen again. And we know that the Kremlin has a very strong grip on the state TV. So this is potentially one glimmer of hope that state TV and the media in Russia has pretty much gone oddly quiet since there was this peak in December about rhetoric of Ukraine.
AMH, thank you. Anne-Marie, our Washington correspondent down in D.C. Right now, equities lower, 0.4% on the S&P, about 22 minutes in. With your sector price action, Here's Kriti Gupta.
Well, good morning, John. Fairly red, a lot of red on the screen. You're seeing a lot of selling pressure. The one really big pocket of green here is going to be in energy, and that is, of course, following oil prices higher. But even with you have yields that have been higher. Financials have been the outperformer lately. You even have a little bit of pocket of green in banks, but not able to bring the entire financial sector higher as a whole. That being said, to the downside, you've got consumer discretionary, consumer staples, tech really weighing the index down as usual. One of your biggest weights is going to be IBM after getting a sell recommendation at UBS, but you're also seeing a lot of action in the chip maker space as well. AMD, this is one of your positive movers on the day, getting an upgrade over at KeyBank to an overweight thanks to robust cloud data center growth in 2022. Intel as well was one of your pre-market gainers after hiring Micron's David Zinsner as CFO, but that news not enough to withstand some of that really aggressive selling pressure you're seeing in the tech space this morning, John.
Kriti, thank you. Thank you very much. Coming up, your market moving events that you need to be watching. That'll be next in our training diary from New York City. This is Bloomberg.
Many people who are minorities don't any longer believe in the American dream. What do you say to these people about whether this country really still exists for the American dream?
The American dream is possible, but it is failing a lot of people because of some of these racial blinders that exist.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How are
story.
you thinking about those dynamics?
I do not believe we have an ethics problem. I think what happened was there was illumination on things that gave an appearance issue, right? They were technically correct in terms of the rules, but it was the appearance issue. The chair and the Fed are taking actions to strengthen the rules upon which we have to abide, and I think that is addressing the situation.
That's the view of the Cleveland Fed President, Loretta Mester, just moments ago, exclusively on this program with Mike McKee and myself. A view that maybe carries over to Chairman Powell's testimony, his reconfirmation hearing in just a moment. Your equity market down 30. We're down again for a sixth day on the S&P by 0.7%. The NASDAQ down by 0.5%. That's the price action. Here's the trading diary. Top of the hour, Fed Chair Jay Powell heading to Capitol Hill for his renomination hearing at the top of the hour. And no one's been asking whether he actually gets confirmed. That gives you an idea of the story that's set to play out in front of us. President Biden speaking later this afternoon. Host of Fed Speak through the week. Look ahead to that. US CPI tomorrow morning is a big one. 7 handle expected. Then on to retail sales on Friday. And we kick off earnings season with JP Morgan. From New York, thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg TV.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lines from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all of this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.